Well, howdy, folks. Our first international hangout. Today, we've got Hans from the other side of the world joining us, and this is going to be a ton of fun. How you doing, Hans?
Great, thanks. I appreciate you inviting me.
And where are you calling in from?
I'm calling from the very northern tip of Switzerland, a town called Hallau, a wine growing area, Hallau, right next to the German border, right south of the Black Forest. I grew up here.
Well, that's wonderful. I mean, well, we'll talk about it later, but hopefully I'll come out and visit you sometime. So you do a meetup out in San Francisco that I spoke at. You're nice enough to have me there last year. I think it was last October. You're doing another one this October, October 3rd and 4th, I believe.
Yes,
Is it? And then you have another event on the 2nd, and
yes.
we'll be getting into that in a little bit, but because of that, I wanted you to come on and people to get to know you because I was so impressed with everything that you put on last year with, all the people that you brought on and facilitating it, and you brought your family out, and it was really a very nice event. So we'll get into that, probably towards the tail end and circle back to that, but that's why I wanted you on so people could get to know you. But why don't you tell people a little bit about your background and how you ended up trading our style?
So I grew up in Switzerland with a socialist family,
Okay.
and one day I looked at a passbook. I came across a passbook account of a friend of mine who was 2 years younger. And I saw these entries about, he deposited some money in 100 francs and then he got like $2 in interest at the end of the year. I was in third grade and I was fascinated by that. And ever since then, I was really interested in financial markets, and I read the local newspaper, read the stock tables, and I grew up in the '80s, so there was a lot about forests dying, and the acid rain they talked a lot about, and they said in 20
Yeah.
years there will be no more trees. So as an 8-year-old, I went door to door to raise money for Greenpeace because I drank that
Oh,
Kool-Aid really. But then as became a teenager at 12, 13 years old and studied the stock market more, and I had a particular friend who was into market economics, I kind of shifted from saving the world through Greenpeace and raising money. I was more like towards saving the world with financial literacy and teaching that
oh,
to others. First learning for myself, but really learning the system and maybe changing it a little bit from the inside rather than being an activist from the outside. So that led me on a really long journey of a lot of trial and error. I tried to get an
that's the way it
apprentice.
works, right? For all of
Oh,
us.
tell me about it. Learning by
Yeah.
doing. I was knocked over the head so many times.
Yep.
More times than you, I believe, but yours might have been
No,
a little bit harder than
you'd be surprised, man. We all learn the same way, man,
mine.
the hard way.
So yeah, what happened was I opened a brokerage account at age 17. A friend of mine opened it in his name, and that was JB Oxford and Company. It was a brokerage discount in England. It was an
Okay.
offshoot from an American company. I had to call in, and a trade was $35 at that
Yep.
time. Really, really cheap. Back then, you paid easily 100. And then
Mhm.
I also started a club. It was called Overcash Club at age 16 in Zurich. I
Wow.
went to work in Zurich for the post office. I wanted to go to a bank, but they wouldn't take me at the bank. I was a little bit too rough around the edges. So I ended up doing an apprenticeship at the post office. In Switzerland, most kids out of high school, that's when they're 15 or 16. We do
Okay.
9 years of schooling. They do an apprenticeship program, a structured 3 to 4 year program.
Oh,
So
I
I did
didn't know that.
that. And then I met my wife there and we had a son, and then we moved to the United States. My dad is a US citizen. So I got citizenship at birth. So it was a little easier for us to move there. And we moved
Oh,
to
yeah.
Northern California in 96 and I studied economics. Another common thing you and I have.
Yep.
The Humboldt State University, and I ran track there. And then I worked for Morgan Stanley. And so through all this time, I studied the stock market. I know I experienced the dot-com boom and bust with, my
What
2000.
year did you come, to the States?
in 96
90. Oh, okay, that's
up
a good.
to Humboldt County. That's way north.
What drove you? No, I know where Humboldt, and people love it up there, so green and all, what was the reason? Was it your wife that wanted to come, you wanted to come, or what made you decide to change? Because that's a big change.
I don't know. I've seen some things in National Geographic when I was a kid, and it was for me. It was between New England and
Mhm.
the West Coast, and
Okay.
so after my military service, I went. My grandparents they lived in Ohio. I went with a friend and flew to Ohio. We bought an old 1977 Ford station wagon, and we
Hmm.
took it along Route 66
Oh,
all the
that
way
must
to
have been
San
fun.
Diego. It was a blast through these ghost towns. And then in San Diego, he stayed there and attended a language school for English. And I drove all the way up along Highway 1, all the way up to
Oh,
Humboldt
that's
County.
beautiful.
And I had these schools. I was this advisor, a lady in Switzerland, that was pre-internet that gave me a list of all the potential schools that I should apply for business. I wanted to study political science at that time. I
Okay.
switched later to economics. But anyhow, so I took that old 1977 tank, which had, you know, automatic windows and
Oh,
seats. It was
wow, it's
an
ahead of
amazing
its time.
machine. Yeah. And I don't know how much
Did it
gas it
have
cost.
wood paneling on the side of
And
it?
no,
Like,
it was not a Woody. It was not a
okay.
Woody. It was even bigger than a Woody.
Oh, wow.
Massive tank.
I have,
Anyhow,
visions of the movie Vacation in their big giant station wagon. Do you remember did you ever see that movie Vacation with Chevy
I
Chase?
didn't, but I know the Woodies.
Okay. Yeah,
Yeah.
those are beasts.
Well, my friend and I would sleep in the back, and one would drive, one would sleep. And then I took their car up Highway 1 and just went right through LA, didn't stop there. I'm a country bumpkin. I grew up, in the countryside. Just cruised through there, went to a few colleges in the Bay Area. And then when I ended up in Humboldt County, I saw on the side of the road, I saw the Swiss cross. It wasn't a proper Swiss cross. The proportions were out of sync, but I
Uh-huh.
saw the Swiss cross and it said Humboldt Swiss Club. And I'm like, I'm in the middle of nowhere, and there's Swiss people here that have, actively involved creating Swiss community. And then when I arrived there at Humboldt State University, it was a Sunday. I was like, this is it. This is the place I want to move to. And that was in
Oh, that
95. And then I went back with my wife and our 6-year-old son a few months later. And then we moved there in 96 and I attended college there.
oh, wow. Well, what a fun journey, and with the family and all, and yeah, going up and down the highway in California, there's nothing like it. It's just so beautiful. I did a lot of that last year during my road trip. Well, great. So then, when did you find Bill's book or IBD? How'd that
Well,
come about?
just one thing.
Sure.
Highway 1, speaking of Highway 1, the
Yeah.
portion north of San Francisco, all the way up to Humboldt County, it's pristine.
Yep.
You don't need anything else. Just cruising up there, just take it slow. It's just amazing. And it's not overrun for the most part. It's meditative, just cruising through there. Um,
Yeah, I would totally agree with that. Like, so last year on the road trip that we took, I didn't have any plan. Every day we just go wherever we're gonna go and then just stop. I had a general plan to go up to Seattle, see a Hendrix museum there, and then over to Yellowstone. But we never really got too much further than like mid Oregon. And then we decided to just go over the coast and come down and go through Eureka and all the redwoods and all of that stuff. And that was just so beautiful. I mean, we got to a point where it was getting overwhelming because my better half and I were like, "What's your favorite part?" Well, favorite part was Crater Lake, even more so than anything else we saw, including seeing the Grand Canyon for the first time. I mean, Crater Lake was just. Have you been to Crater Lake?
yes, yeah.
Yeah, I mean, just stunningly gorgeous. But then going through the redwoods and then coming down the highway there, it was like almost an overload. And we ended up all the way, coming all the way down to Big Sur and doing that whole thing. And it's just what a beautiful part of the world, really. And
It is.
you can't go wrong with that. So sorry I got off on that
Yeah,
little
no,
tangent.
sorry, I did. So what happened was, I finished my degree in economics and I went to work for Morgan Stanley. We have to read Random Walk Down Wall Street, and that messed me up a little bit because I was like, okay, I can't outperform the market, so let's just put that aside and let's just
Do
put.
you remember the section in that book? I think it was a chart that they had, and they said something like to the effect that, a technical analyst will interpret this, but all it was is someone flipping a coin. Was that from that book?
It
And
is.
yeah, I read that in college, and I'm like, you know, what a joke all this stuff is. It was really
Well, it's like with all of
ridiculous.
economics, it gives you a framework of thinking. And if you just, as a baseline, assume the efficient or the strong form of
Mhm.
the efficient market hypothesis, which says any information, even inside information, is always represented at any given time in the stock
Yep.
price. Any new information is absorbed within a minute in the stock price. Just have that as a baseline. It's a great frame of thinking because overall, I mean, 97% of all investors don't outperform just because of the fees. You know,
Yeah.
for most people, that's a great theory, but it messes you up when you are searching for a better approach for an individual investor.
Mhm.
But anyhow, so I read that. I was taught by these. We also did, Warren Buffett way, whatever that book is called.
Yeah, I read that one too. I'm actually a big fan of Buffett. I don't trade at all like him, or well, he's not a trader, he's an investor, but he has such great one-liners that are just really resonate with me, and people should go back and get the Berkshire Hathaway letters to shareholders that, I used to get. They used to send it out for free, and it'd be like this thick, and it'd be like 10 years at a time, but I'm sure they're all over the internet now, but it was just packed full of so much wisdom. I think my favorite thing from Buffett was his circle of knowledge concept, and I've been using that since the '90s. Of just have a very small circle of knowledge. Just find something that's interesting to you, and just know every last thing about it. You don't have to spread out and know
Yes.
everything. And what are some of the takeaways that from Buffett that you got, if any?
So it's all about present value, future cash flows. And of course, you have to make some assumptions about the risk-free rate and the growth rate and everything.
Mhm.
So that discounting model that human beings are, it's not just discounting to the present, but it's discounting it, applying probabilities,
Mhm.
which is
Yep.
why certain stocks like Amazon that have had a lot of losses on the books still went up, because of that
Yep.
present value of future cash flow weighed with probabilities times all the actions of the collective investor community, including short sellers. So
Yep.
that was really for me all about net present value, future cash flow. I also took some finance classes, so it was a great framework to know all that.
And
And
that's
then
what so much of the street puts so much weight on, like, almost all their weight, not in our world, because our world is very unique, and we look at charts, and we look at fundamentals on a very, very basic level, but discounted cash flow analysis is really at the core of what the rest of the street does, and they feel comfortable, and valuation models and everything, which it is important to understand that that's how they think, because then to try to gain some sort of edge or comprehension of, like, okay, Amazon was so rocky over the decades because Bezos was smart enough to just go, forget that model. I'll dial in the earnings whenever I really need to. And you saw him do that over the years, where he was playing the long game, kind of like what
yes,
Japan always used to do, of not worrying about the quarters or even the years, but saying, okay, I'm going to look out 5, 10 plus years. And that's what Bezos did a great job at. But then when the stock was under enough pressure, he would go ahead and make those discounted cash flow folks happy by just dialing things a little bit and then getting those earnings going. Then the would get squeezed. Then he'd start playing the long game again. Stock would come down, and over and over again. It was just fascinating to watch that shift, wouldn't you say?
Yes, absolutely. It's a lesson in rationality in the very long run, and a lesson
Mhm.
in the short run of psychology and people, reacting to things.
Yeah. Wouldn't you say the most, even though we look at charts, we look at fundamentals, each from a different lens, and we look at the market, but in the end, it's all just about psychology, fear, greed, and hope that we learn from Livermore. At least that's how I look at it. What are your thoughts on that?
So what I look at is time frames, so short term, why does a stock move, you know, millions of bips, millions of ticks a
Hmm.
day randomly around, but in the
Yeah.
end it meant maybe 0.5%, but it hit all these different ticks,
Yeah.
all the time. Why does it do that? And that's purely or 90% psychology. Why
Uh-huh.
do stocks sell off when Trump comes out with these tariff things and go down back to back over 5%? And then they jump whatever 10% that Monday following Liberation Day. But then in the long run, say 20 years or more, that's what I look at long run. It's all rational.
Hmm.
It's all present value, future cash flow. It's all valuations. But short term, it's just pure psychology, and that's what we deal with. Genslim, I heard you say that the charts are really representation of the collective, like psychology
Yep.
of humans on a daily
Yeah, it's just
basis.
mass psychology on parade, as either Bill said or I said or someone said. But and that's what's so fascinating about it is just watching group think. But you're right, in the long run, if you look at a monthly chart that has an earnings plot on it, something that we're going to be adding to Market Surge when as soon as we can, it gives you a different visual, and especially if you do it instead of on a best fit scale, you do it on a 10 times or a 20 times scale. What that does is it locks it in, and you can see the valuation, the distance from the price to where the earnings are. And if you do this on enough stocks on a monthly basis, you could walk away with one obvious thing. Given enough time, the price just follows what the earnings are doing. Like,
Yes.
and it goes back, and that's why it's
Yes.
so big on the discounted cash flow analysis and everything, because they're trying to predict this along the way, but all the wiggles and wobbles are where guys like us try to get our edge. And so we're seeing it going, okay, if I was patient enough to be a Warren Buffett who's going to buy this here and I'm going to hold it for 10 years. And even if I could be down on it 50%, and I'm still going to hold it, and maybe from that lens, they buy more because if it was good at 50, now it's at 40, why not buy more? I mean, we can't, that's so foreign to us, but that's that group think on the other side, on the valuation side. But it's important to understand that that's what does drive it over the long term. But in the short and the intermediate term, like you're saying, it is that the emotions, the mass psychology, the fear, the greed, the hope. And what you said about the tweets from Trump or from anyone that is important, like something from the Fed, or let's just take the President Trump stance on the tariffs and the market selling off, or what happened after that with Iran. That my interpretation of that is the market sells off because now in all these discounted cash flow analysis, Excel spreadsheets and such, and valuations, that camp doesn't know what to do. Like, what value do we put in there? And you were saying about, okay, the risk-free rate of return. Well, when you've got all these things going on, then you have this becomes an unknown. And instead of going in there and saying, okay, the risk-free rate of return is going to be X, they have to do it as this spread between either up here or down here. And then you do that on each thing, then all of a sudden their valuation models fall. So they have to sell to be in line with it. But if you just give it enough time, the market will tell you, because then at some
Yes.
point the market gives you this, the market knows, and then they can put it in their spreadsheet and go, okay, well, before we thought it was 3.5, now when the news came out, we thought it could be 6.5 down to 2, this huge range. So the prices go all over the place. Ultimately, it might not be exactly 3.5, but now they go, okay, well, it'll probably be between 4 and a quarter to 3. So therefore now we know how to play. things firm up, and then you move on to the next crisis. There, that's just over and over and over again. That's what bear markets and intermediate corrections are formed. What's your thought on that? Do you agree? You don't have to agree. I love it when people disagree. So, what are your thoughts on that?
It's not for me about agreement or disagreement. What I find really fascinating about what you just said is that, first of all, there is this gospel of like, the terminology of financial markets like capital asset pricing model,
Mhm.
rebalancing, reallocating, asset allocation, and efficient market hypotheses. That
Mhm.
all sounds very scientific.
Yeah.
And it makes people that are not salespeople, like stockbrokers, like I was at Morgan Stanley, or like you were at whatever firm, or no, you were like, I think, research or something, but makes
Yeah.
them, the salespeople that we are, that I was at Morgan Stanley, sound more like, oh, this guy's really smart. He's talking about asset allocation. Wow. And he has an economics degree, summa cum laude, and all that. But the thing is, in the short term, it's all our biology, our human beings, when we were in the forest, it helped us to recognize patterns when we heard this roar and
Mhm.
we saw one of the fellow human beings eaten by the saber-toothed tiger. Next time we hear that roar, well, we're going to run away.
Yep.
Uh, and learning quickly from these patterns really throws a monkey wrench into when you look at patterns in the stock market. And then you look at the patterns, see stock go down, and your biology says, oh, let me check the news. What made that stock go down? Something must have happened. And then you turn on the news and it's CNBC, Bloomberg, or whatever, and they say, oh, the Fed did this or that, or Trump did this or that, or whatever it is. It doesn't matter what it is, but they put a cost to it, but they don't
Mhm.
weigh that. When I see a piece of news, the Fed did this, and say, oh, probably 80% chance the market went up because the Fed lowered rates. I don't know, but it's probability. And
Mhm.
they make stuff up all the time in the financial media. And
All the
sometimes
time.
in the morning, the stock market goes up and say, oh, because the Fed raised rates, the stock market's going up. And then it goes down in the evening, in the afternoon, and they say, oh, because they raised rates, the stock market's going down. And there
Yep.
was instances. I mean, I've read this. Some guys are following that, or in books they write about this, and that's why I'm in the Can Slim community, because the Can Slim community gives you more of a structure, and it takes away from that, or it gives you, the factor is kind of out the
Yep.
door. Because at Morgan Stanley, I was trained to come up with stories when the stock market
Yep.
was down. It was 9/11, this crisis happened that nobody expected. So it's not my fault. But when the stock market was up and their accounts went up, well, then I'm the genius.
Yep.
And so this farce that we're all run around, watch CNBC and all this stuff all day long. I don't do it anymore, but I did
Yep.
some of it in the past. I mean, I do it for entertainment purposes. I
Mhm.
write a weekly newsletter and I mention stuff like that in there. So, coming back to today, what I went through with college and learning and relearning, and then, believing what I taught at Morgan Stanley. I was a great salesperson there for them. I really believed what they taught me. And then having to unlearn all that through Can Slim was a great journey where I now I'm really motivated um, to bring to others, like in the meetups, um, to not do the stupid things, or I call it low hanging fruit. Pick the low hanging fruit first. Don't go speculate with penny stocks. Just put $500 into your IRA or your 401k each month. Max out your K to where you get the match. That's a 100% risk-free
Free
return,
money.
because it
Yeah.
puts the match in, and you get a tax break on it, and it grows tax deferred. Do
Yep.
that first. Do the rational stuff. And so I've been thinking so much about the market and how people make decisions. And I'm a really flawed investor. I
We
don't.
all are.
Yeah, exactly. But there's some people like Michael Nestler. He's so good at, or this other guy, Harry Friebel, where they take the stuff and for them it's nope, and they make the same mistake maybe 2 or 3 times, but I make it 10 times. You know?
Yeah. Well, I think I think most people do make those mistakes. There, I mean, there's a reason why you make a mistake, right? Because you're There's a couple different type of mistakes. There's mistakes where you know better, and then the ones you don't know better. I think we make the ones where we know better, and there's probably a bit of something else, like on a subconscious level, where we're trying that trade again, and even though we know we shouldn't, because we do know sometimes that that pays off. I'm not saying that we should do that, but that's one mistake, or one type of mistake that would make. And then the other one, yeah, that's just, buying a 2-cent stock or a $1 stock, or it's like, dude, what are you doing? That's just that's nonsense. But I do want to go back to, you made so many valuable points there. And from the, let's take the CNBC thing. I used to watch CNBC all the time because it was really a good news, a real time news thing for me. Like, okay, the market's selling off. Most of the time it would be on mute, but I'd have it up there so I could see the headlines. But then and especially when I was out, out here in Austin doing the fund, where I'm just in my office by myself, can't talk about the market with anybody besides the folks at the firm, where it's isolating, and it's nice to kind of have that on, but it never helped me, because what you were saying is so true. In the morning they say it's because the Fed did this, and then but it goes up, and then in the evening they have the same story but why it went down. And you can't blame them, because they're
Nope.
looking for ratings, right? And they have to say something. The market did something. They have to have an answer for it. But many
Yes,
times you don't have the answer, right? It's like the answer
exactly.
doesn't come for months. And then you're like, that's as old as the hills. Like Livermore would say, like, you find out the next week or the next month. So I think, and no offense, because I like some of the people, and I have friends that go on CNBC, and and I like Jim Cramer a lot, because
Yeah.
I think his work ethic is there, and his mission is to help people, and people give him such a hard time, and it really bothers me, because he's just trying to help people. And look, if he's on a show every day, and he's going to do three whatever. I used to watch his show all the time. I haven't watched it in
Mad
many
Money.
years. Yeah, Mad Money. And it's like he's got to talk about something every day, so he's going to be wrong a lot. Anyone who talks about stuff all the time, they're going to be wrong. And but it's, I just feel bad for the dude, because I think he's a good guy and super smart. I'm sorry I got off on those tangents, but that's what we do here on Webby Rambles On, is we like to go down tangents. So you were at Morgan Stanley, you were doing the sales gig. I can't see you as a salesperson. Like, sold for one day of my life, and realized that that's not for me, cold calling, and it was a disaster. So you just don't come across that way. I mean that as a big compliment. Bill was a huge salesman, and he loved it. Him and I had some, he wanted me to read sales books on how to sell. And I'm like, no, I'm not going to sell. Like, that's just not in my DNA. And he didn't understand it. But he was at heart, he could sell ice to an Eskimo. Like, he absolutely could. So you go through the Morgan Stanley thing. Then when do you end up leaving Morgan and doing something different?
So I was really proud to work for Morgan Stanley, and we started off with 232 sales reps. I went to New York City for sales training. They called it something else, but it was all about sales. It was really nothing else.
Yeah.
And then um, they about 85% of all the trainees washed out, and
Wow.
15% stayed. I was one of the 15%. I got like this whatever rising star designation. And then I worked with another guy who started a little bit later, and he worked for another firm. They were raising capital for some real estate development, and a client of mine invested in that. And then they alleged that I had sold away, and they fired me. I
Oh,
was a little bit of
wow.
a situation in that office with a new branch manager, and he then took over my books and whatever. So they fired me, and the world really crumbled for me at that point,
I'm so
because
sorry, man. I'm so
I had,
sorry.
4 kids and everything. And then it kind of followed me, because then it was a whole story with heirs, and very rural county north of Humboldt called Del Nor County. And the DA there knew the heir of my client and whatever. It went on and on. The client didn't have any kids, and it was an older fellow, but real estate developer. But anyhow, the long and short of it is they fired me for cost. They said I sold away. Selling away means you're selling an investment without notifying your employer.
Oh,
Uh,
gotcha.
but I didn't sell. I didn't get compensated, you know. But they said,
Oh,
"Oh, technically, you said you should go into this investment," which I didn't. But I attend some meeting, and I was too impatient, I think, for success. You know, I should not have been in that meeting. But anyhow, the long and short of it is, they kind of followed me almost to today,
I'm so
to
sorry,
more,
man. That
more
sounds
or less.
terrible.
And just starting to come more into my own again, you know, after all this. Because so then they fired me. Then I started working for Raymond James Financial Services
Okay.
and as an independent rep. But at that time, there was some, like, in the community there, some negative press and so on. So it was hard for me to kind of, you know, bounce back. And I had all this expense, so all this overhead. And my assistant Jennifer, she was the greatest. They gave me a full time assistant at Morgan
Oh,
Stanley,
wow.
rookie, because they could see, you know, that the old branch manager, he really
Yeah.
supported me. And a new one came in shortly before I was fired, and he fired me. And she was the greatest. And then and I paid her well. I paid her $4,000, which at that time, you know, in 2003 was a lot of money. So she moved over with me.
It was more
And
than Bill was paying me.
oh, really? So anyway, we're a great team, but it was just a lot of overhead and everything. And then we moved to the Bay Area and to Mill Valley, and then we had 5 kids,
Well, no, 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 I take that back. It was about the
and
same,
then
but
we were really in the rat race, you know. I mean, the expenses there and private school
that's
and
as
just
expensive. I mean, it's either that or New York City. Those are the 2 most expensive areas, right, of the country
yes.
to live.
Yeah, it wasn't
I just feel
financially smart.
terrible for the situation that you were in, and I just knowing you, that it just doesn't seem like you would have done anything intentionally wrong, and if someone is looking for something to get rid of somebody, you can always find some sort of technicality for something, and they don't, and I've seen it. We've both, been around the block enough that you see that, and it just leaves such a bad taste in my mouth because it's like, look, if someone isn't working out at a place for one reason or another, to be honest about it and just do it the honest way. Don't find something that then ends up haunting them. And I just sincerely just, man, I feel terrible. And karma will get people like that. And the best you can do is, if there's anything to learn, learn from it. And if there wasn't anything to learn, just learn that sometimes really crappy things happen in life and you just got to move forward. A lot easier said than done because, like I get it, but yeah, I
I know
just
you
feel bad. Yes.
I know you've gone through some hard stuff, and, you know, I had to do a lot of work together with my wife. I'm blessed with a really patient wife,
Yeah,
and
I met
her
her and she's just a sweetheart.
yeah, yes. So I went from, like, you know, revenge kind of thing
Hmm.
to, you know, acceptance and it's a learning experience, and not to hold it against them, you know? So,
Well, that's great that you have that to lean on, and, that's really important. Not everyone ends up in that situation where you have somebody that you can lean on, so that's great to have that foundation there.
yeah,
One other thing that you talked about that, circling back to your comment and you were saying about CNBC and then the news flow, I think it's important for people to realize, and I'll tell you my interpretation of things, and then I want to hear if you have a different one, that you mentioned 9/11. And so if you put yourself back in that mindset of the 9/11 happening, in forgetting the humanitarian aspect, but just from a stock market standpoint, because
yes,
that's what we've got to talk about today, that at first, any little thing, any news item that would come up, on the wires or on the internet or anything, there would be a huge sell off in the market because there was a worry that, okay, there's going to be another event. And then as time went on, and it took maybe, I don't know exactly how long, but probably took at least a year, if not longer, after that event, where when the news item would happen, if you graphed it out at first, the distance would be like this, and then slowly it would get like, smaller and smaller when a blurb would come out. And that's kind of goes back to our earlier conversation about the discounted cash flow and not knowing where to put things. people kind of get used to the news, and then it's no longer important. And even though it's all over CNBC, or I don't want to pick on them, but any news outlet, including IBD, like, we're a news outlet that, but I think we do a much better job. I'm not really objective there, but I think we do our very best at least. But everyone will still be making a big deal about the news, but the market isn't, and that's where you gain your edge. What are
Yeah.
your thoughts on that?
Yeah. So you were interrupted for a little bit. So I'll just, but I get the gist. The connection wasn't that good.
I'm sorry.
So no problem. So basically, what I think, if I was a regulator or a benevolent, I don't know, overseer of the investment world, what I would highly recommend the news outlets to say all the time, this is an interpretation. Probably the market dropped because of such and such, and these are assessments. We don't know. We have no clue. We don't know a cause and effect. Correlation is not causation.
Mhm.
And there is so much talk when something happens. I listen to it too when the Fed makes an announcement. I love to listen to the Fed chair
Yeah.
during the interview. I half an hour later, and it's like a charade. The reporters ask all these questions, similar questions each time, and they're all playing something. It's all an illusion of this paper money that we all have, you know? So I
Mhm.
just find it fascinating that we're so into it and so listening to the news when we never know for sure. Of course, the totality of all the news absolutely determines the stock prices, but all the noise in between, all this huge moves up and down is for naught for the long-term investor. For me as an options seller, it's beautiful. And that's why I've been studying more and more of that, the psychological aspect, like during the freedom, what is it called? Liberation Day.
Mhm.
VIX went up briefly in the pre-market on Monday, I believe, up to 60, 61 or 62. And what a beautiful display of the panic aspect. And then
Yeah.
2 or 3 days later, it was below 30, like below 25 after like 4 trading days. It was such a beautiful display of how quickly it can change. And you can benefit from that, as an option seller to some extent, and sell that fear a little bit and then
Well, why don't
cut
you
back.
walk through that? Because going back to the Warren Buffett thing, I've stayed away from, although I will trade options in a very basic way, just on a long only side, just buying some calls, typically out of the money, But the circle of knowledge thing, I haven't gone because I've got a very obsessive personality. And so I know if I start going down the option route, rabbit hole, I'm going to be down there for, I give it 3 to 5 years, of which I don't have the time to spend right now on that. And I never have. Every time I'm like, oh, I don't wanna go down there because I know I'll wanna learn every aspect of it, so I don't go into that world. So why don't you enlighten me and our viewers of, you're in that situation where the VIX is spiking up. For someone who doesn't understand what the VIX is, explain that, and then exactly tactically how you would be doing that, and also, are you doing that on individual stocks? Are you doing it on uh, index-based ETFs, or are you a combination? So just walk through how you capitalize on that.
So first, speaking of the topic, let me go back a few years and give
Sure.
you a little bit more color on my options journey slash Ken Slim journey. So
Yeah,
during
yeah.
at Humboldt State, I was able to take a graduate class on options, and this
Hmm.
lady, this kind of buff lady, she's just a younger student or a grad student. She taught an option class, but she didn't know anything about options. She was super smart, and she always read the chapter ahead and then taught us that. And I didn't understand anything, but I got more interested in that, and that was like in '99, and then that was just kind of dormant. And then in 2001, which is a year after I started at Morgan Stanley, this
Mhm.
stockbroker guy, a Swiss guy that I know from the Swiss community in the Bay Area, he said, you got to read this book. I didn't know him that well, but he was really firm. He said, read How to Make Money in Stocks.
Oh,
And so, I read it and
this one, it's
similar.
never too far from me.
Yeah. And something similar to you happened to me. I remember I was traveling. I was in a hotel in the North Bay. I was in the hot tub and I was reading the book. And Bill writes in the early chapters, he says, "You won't get rich sitting on the sofa drinking a beer." And I think he might also have said watching TV, but I remember sitting on the sofa drinking a beer.
Yep.
And so that was one thing I was just like, oh, wow, this guy's really like a plain dude down the earth.
Yep.
Why would you write something like that when I learn
Yeah.
all about capital asset pricing model and these charts and this? So hard work was one thing. But then the other thing that I realized, I was always looking for the holy grail since I was, I don't know, 12, 13 years old, like, oh, I'm predicting the stocks and
Mhm.
doing commodities and just random stuff, .com stocks and penny
Yeah.
stocks. And it's just looking back, it's just like, wow, crazy. So then what I realized is the holy grail of investing is there is no holy grail, but it's a totality of input, the fundamentals, the risk management, the charts, having clarity in decision making, and having a really clean rule set. And when I got that book and I read it, I really, for me, it was like a sacrosanct. I'm like, okay,
Mhm.
this is good. I'm really going to follow this to the T because I'm
Mhm.
more of an impulsive person and I'm sometimes not
Really?
that. Yes.
You don't come across that way at all.
Yeah, I'm rather impulsive and not thorough, and I'm impatient inherently. I had to train myself not to do that. Like my
Yeah.
parents are so scattered all the time. I mean, they're smart people, but they're so like all over the map. So now I have
Interesting.
to. My wife is the opposite. She's a great compliment to me. But what I realized through how to make money in stock is it's a framework. It
Mhm.
gives you clarity in decision making. It gives you risk management, and I've never violated a single time the 7% stop loss.
Good for you, man. That's
I
awesome.
violated other stuff in my other investing, but
Yeah.
Can't Slim gave me that structure, that simplistic structure. And then, I went through level 1, level 2 a couple of times, level 3 2 times. And you see these other investors that are kind of bumbling along, and then they give you the structure, cup with handle, W, flat base, all these. And I love to go through these charts, and so anyhow,
Did you ever get to see Bill present live at all?
no, I never saw him live. So at
Okay.
that time, I wasn't really like money was always an issue at that time up to, I don't know, 2015, 16. So I
Mhm.
couldn't really afford, with a family, and
Yeah.
then and my wife didn't, work
Yeah.
gainfully, and we flew back to Switzerland, and you had a house to maintain. And
That's a yeah, that's
I couldn't afford it.
expensive with that many mouths to feed, man. That
And of course, I'd taken a class, but I was always so I then, before going to the options bit,
Mhm.
uh, kind of talk about my canceling journey. So
Sure.
up in County, there was a meetup group, a canceling meetup group, but it never got
Oh.
off the ground because you needed so many people to sign up, and there was only like 3 or 4 people, and that was in 2001 or 2002. IBD was so far ahead at
Mhm.
that time in
Yeah.
organizing investor or their clients. And that was such a great way to organize people on the grassroots with IBD groups. So when we then
Well, and
moved,
let me just stop you there, because people might not know about the meetups, of which you're in charge of the San Francisco one, but this was an outfit that would just get together, people that had a, common interest, whether it was whatever was not, it could be, fixing cars or cooking or what have you, just meetup.com or something like that. And
yep,
then someone sold Bill on the idea that it was kind of that grassroots of people like you who end up having the knowledge and want to share it with people,
yes,
and it was very, very low cost or free, just people paying for, if you got to rent out a spot or something, you got to pay something to, to cover travel costs and things like that. So it wasn't a money maker for people, but it was something that was helping. And Bill was such a big fan of that. And then you would have Charles Harris and I go and speak at a few of these. And we really didn't want to at the time. It wasn't because we had anything against it. Our workload was just massive. But then once we did the first one, it was great because we would be speaking at events because I would teach workshops with Bill, and yeah, the price point was 3 grand for a day. And then when I would do it with when Chuck and I would do things, it was 3 grand a day for chart school, and 3 grand for the market school, a separate day, and then for the ones with Bill for the weekend, it was like 8 to 10 grand. So
I know, yeah.
with with that, those price points exclude so many people, and the people that really, really need it. Because if you've got 8 or 10 grand to spend on a weekend to become a better investor, that's great, and we can get you from your account that's X million up to more than that. But what about the person like me who started off, it took me 6 months selling everything I owned to
I know.
raise, to raise
To get
$540 for
down the
40
chairs around lot, correct? That you
yeah,
wanted
for
to buy.
40 shares of Robert Mondavi, which is a wine thing. And those are the people that Bill really wanted to help out. And so he was such a big fan of that. And I'm going to share your thing here in a second because and we'll circle back to it again at the end. Okay, so here, just since we're talking about the meetup, I wanted people, if they're interested in your meetup, here's one aspect of it, and this is the option selling one, and then you also have the stock one. But going back to what I was saying about the meetups, is Bill was such a huge fan of those, and he would push us on those, and he would go and speak at those. So here he would be charging all this money at this one event, and then he'd go and speak at them, not often, but when he had the time. And it was really important because it's near and dear to, I think, your heart and my heart and Bill's heart and the other people in the meetup community, of spreading the word and trying to help others. So we'll circle back to your journey in a second, but just since we have it up, why don't you talk about the October event and what your meetup is about, and then we'll kind of go backwards again.
Yes, yeah. So this is the former San Francisco IBD meetup group. You can still kind of see it in the URL, meetup.com/IBD/95. But it's no longer it's no longer an IBD meetup group. They've all been disbanded. We're now called Growth Stocks of San Francisco Meetup Group. And Ida and I, my youngest daughter, we've been doing this for 11 years now. We have two helpers, Greg Farber, who does all the tech, and Ralph DeSimone, who does all the logistics and negotiating with the hotel, that help with the meetup, and then all the great speakers. So this came about with two other meetup leaders, Lee Tanner from the Petaluma meetup, and then David Ashish Dave from the South Bay. And so I said, hey, why don't we do something together and get a bigger group together? It was a one-day event. We had boxed lunch up in San Rafael at the Hyatt, I believe, or some hotel for, it was like $15 or something. And I think that we charged like 20 or $25 in 2015 just to cover our cost. And we were not allowed to charge more than our cost. Some of the meetups got shut down because they charged, like, I think the San Francisco one, Naperville. And so we never charged more than just to cover our expenses. But then it morphed into a 2-day event and with more speakers. And I used to be a speaker. And my philosophy is, if I can find a better speaker that I feel can bring more to the table, more to teaching advanced can slim / growth stock momentum principles, they should speak. I haven't spoken for
Well, it's
maybe
very
3 years.
humble of you and kind of you to do that.
Well, it's just, I'm looking for people that are really engaged in a subject matter, that really embody a certain aspect, even though I might not agree with their interpretation, but I'm really looking for people that speak their passion. And some of them are really like dry, like Michael Nestler. And I love him. He brings some unique aspects to the table and some unique learning. Then others like Steve Sweats, he's the riot. He comes
Yeah.
in his shorts and he talks funny, and this is the greatest. And Steve has
Then
come to every
I just
one.
recorded one with him earlier this week, and then also with Alex Marenko, both of them which will be at this event in October.
Yes. And then you have legends like Lee Tanner,
Mhm.
who is like very straightforward. Just talk to listen to him. You would really pay $1,000.
Oh, easily.
And
Lee in the
he's solid.
community is, so respected by anyone who knows kind of his approach, and he's very he's got his way of doing things, and he's been wildly successful doing it, and it's just great for the community that he shares his take on things. I think it's just, wonderful, wonderful, and
Well,
saw him last year.
you have all these life lessons too from these speakers. Like with Lee, somebody asks a dumb question, or not no dumb questions, but they ask, "Oh, shouldn't I do this or shouldn't I have done that?" He says, "No." On page 237 of How to Make Money in Stocks, issue whatever number 3, this is what you do. And it's so refreshing, and you have all these different aspects, and it's really more for the advanced, kind slimmers. We always have beginners as well. Last year, we had these 2 20-year-old guys come,
Oh,
which was
yeah,
great,
yeah.
but it's more advanced and more,
And they one of them had really solid questions too, like, he was really paying attention.
A Logan is going to present this year.
Oh,
I'm going to
great.
have him present on his journey and on AI. He's really excited to present. So basically, now it morphed into a 2-day event where we usually do a little travel up or down Highway 1 the day before. And really, we now moved to the original hotel that we started off. We were at another hotel, and things have gotten completely out of hand with the catering and everything with the food. So everybody pays for their own food. We have a great arrangement at the hotel. And so $200 covers the recording. We have professional guy who does all the recording, compiling and everything. And then it covers the room at the speaker travel. We pay for the travel and the hotel for the speakers. And we also have a parallel. Oh, so yeah, I see this is the Zoom version, and there's the live version,
Okay,
as well.
let me switch that one.
This year, what's a little different is that we also have an option selling event. It's really centered around selling options. So it's not the exact opposite of Can Slim, but it's a beautiful complementary strategy to Can Slim. So we do that the day before, because a lot of the people that are in my options group, I started a WhatsApp options group in January, an advanced one and a beginner's one.
Is this the right one for that?
Yes,
But
perfect. So I randomly called Tom Sosnoff's show, Lost Dog. He starts a new endeavor helping people, working class people, or like beginning investors, to get the maximum out of their present value of their life earnings, to optimize that. So he's creating a platform, and he has this daily show. And I just randomly called in and I'm like, hey, we're going to do this option thing, selling options. And he's like our mascot for the options selling, just like you and
dude,
I.
he's a legend in that world. I cannot believe that you got him
Well,
to
he's just
go. That's
so down
awesome.
to earth. I mean, the guy's, I believe he's a billionaire, and he just,
Yeah.
when he sold Tasty
Thinkorswim,
Trades,
right? Or Tasty's
I
Trade,
mean,
yeah.
first he sold Thinkorswim, and
Yeah,
he got about that for Tasty Trades. He got even more, I believe. But then
yeah,
he went back to work like 2 days later. He doesn't have a yacht. He doesn't have, a private
yeah.
plane or any a jet. He's so down to earth. I met him once at a money show in San Francisco 15 years ago. He was just sitting at this little table, and I talked with him. So his what he puts on the show Monday through Thursday is just a conversation with two other guys, or a gal and a guy. So he's going to come to this one, and what I'm really big into is the after party, or the after. I mean, we're all kind of like, most of us are like introverts or on the spectrum, or canceling geeks, or
Yeah.
we're the kind of what do you say, the rocket band or whatever it's called.
We're nerds. Let's just face it, Hans, we're
The
nerds.
misfit nerds and the
Yeah,
misfit can't slim.
there you go.
So what's great is that at the in between, chatting with each other and having meaningful conversations. And I want Tom to be part of that, and you as well.
Yeah, I'm really looking forward to that. I'll be out there working from the hotel in the morning, and then I'll do my Friday SMT that I do with Allie after the close, and then I'll pop up and watch. What time? Oh, it starts at okay. So I'll catch the 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 tail end of that day because I'll be working that day. But I certainly want to hang out with you and Tom and the whole group there. What is the cost for just to make sure that like people know that there's really kind of two things going on here, right? There's the option thing that's on Friday that is
Yeah.
one separate event, and then just for logistics because you're coming all the way over from Switzerland, then the Friday or the Saturday and Sunday is the other event. Do I have that right?
You do, yes. Yeah, and the Saturday Sun is the one that we've always done. It's just we call it now San Francisco Bay Area joint meetups. We're all
Okay.
called like postdocs of whatever, Petaluma of San Francisco. So we're all these former meetup leaders that are all coming together. So that's Saturday and Sunday.
So if someone wants to go to, let's say, both things, the Friday, Saturday, and Sunday, they just walk through what they would do because I would be one of those
So they just go
people.
to meetup.com, and then this URL, the first part up to like 95, they click on that
Okay.
or click on this link.
Okay.
Or they can just Google or go to meetup.com and put in Growth Talks of San Francisco. So then you just go on our website and you won't see all the details of the event unless you're a member of the group, which is free. You can just sign up through Meetup. And then you see, once you've signed up, you can see what when event is. And so we have the options event. Selling options is the art of selling options, not the
Okay.
science, but the art of selling options with Tom Sosnoff. And in parallel, we have the Zoom event too. So the art of selling options is 125 for in person, and then the Zoom is 50. And then the 2-day growth stocks of San Francisco meetup, Can Slim meetup, whatever you want to call it. I don't think we could call it Can Slim because it's
No, I'm not even allowed to say that word, or I might get sued
okay.
because
Yes, okay.
IBD he does not own that word.
Yeah, okay. So
I'm not
it's the
allowed to
San
say it.
Francisco Bay Area joint meetup. Everybody knows what it is.
Yeah.
So we have that. That's $200, and then we have that speakers don't get paid, but they get their travel and hotel and everything paid for. And then we also have a parallel Zoom event for that for $70, and everybody gets all the recordings. It's professionally recorded by Greg. He has all this big setup. You've seen it, Mike,
Yep.
and they get the recording after the event.
Well, that is just wonderful. I'm really looking forward to it. I had so much fun last year Chuck was there, Arusha was there. I'm not sure if both of them are going to be able to make it this year. I know we all really enjoy it because it's just and so many people that I've corresponded with over Twitter or X are there, people that watch IBD live. It's just it's fun getting to see people in person because we used to do that back in the day where we'd travel around the country and do the workshops. At first it was Bill and I doing that, and then when he decided to stop traveling, which I didn't blame him, and then it was Chuck and I traveling around the country, and it was just it was a lot of work. I'm not gonna lie, it was a lot of work and a big distraction from our normal work, but there's nothing like teaching in person. I mean, doing it over Zoom and everything, or recording something, putting it up on YouTube, that's great. But in person, it's just a whole different thing because you can see the people's reaction. You go, oh, they're bored. Let me move on. Or they're not getting that. Let me get into that deeper. What do you prefer, teaching in person or on Zoom? They both have their advantages and disadvantages.
Well, we are so blessed to have the internet and to get so much information for free that we can access. The in person is for me so much more valuable, especially in this time of Zoom and AI and eventually we'll have a chip in our brain and it will just
Yeah.
be all just virtual. So I think it's even more important to be there in person. It's just the value of it is really going up because there's fewer and fewer of these meetings that happen. So I'm absolutely more in favor of the in person. And we didn't used to offer the Zoom
Mhm.
event in parallel specifically to encourage people to come live. But with COVID and everything, we also offering that, which is great for the people that can't travel. But some people say, if you're Muslim, you have to go to Mecca one time in your life. If you
Mhm.
are a canned Slimmer or Grow Stock follower, you have to come to the San Francisco joint meetup once in your life.
Yeah, no, that's true. I have a buddy of mine who will remain nameless but a Muslim buddy, and he just recently went to Mecca for the first time for that thing, and I thought that was really neat. And then yesterday or the day before, when I was doing these with Alex Marenko, who was a professional bodybuilder back in the day, and he worked out of Gold's, and he referred to Gold's Gym where Arnold Schwarzenegger and all the biggies were at as that's the mecca of that community. And I agree with you. Doing something like this really it brings everybody together, and it's at a price point, and I really appreciate that you do that kind of the nonprofit thing, and that you pay for our travel expenses and stuff coming out there, but we're not getting speaker fees. We're all doing this out of really the kindness or the spirit of sharing and caring about our fellow human beings, which is why I really wanted to promote this. And we'll probably have some other of your speakers, on here if they agree to that. And so I can't thank you enough for doing this and bringing your family over. I just that is was so nice to watch with, just was really observing what was going on there, and that was just so special. You're blessed, and that's very neat that you guys get to do that.
Thank you. Yeah, it's just grown into this over the years. I was just thrown into these roles. The Marin County meetup group was abandoned, the one that I joined first, and then before it shut down, I volunteered to take it over. And the same with the San Francisco meetup group, and it's just with Lee and Ashish. Ashish is no longer in the group because he can't because of his employer. It was so chill to work with him. And then there was Greg Farber, and then Amy Smith. She's
Oh,
kind of
Amy
like the
Smith, yeah.
she's the whole representation of the meetup, that used to work for IBD. She used to be responsible with Timothy Reeser, I believe, for the meetups. And she's just such a great soul that kind of just represents everything and the glue of it all.
Yeah, and she wrote her book, um,
How to make money
she was
stock.
kind enough. Yeah, and she had Chuck and I in there, and so many people in there. That was a Bill was a really big fan of that book because he wanted to spread the word that it was like it wasn't just him being the genius that he that was able to make it work, but there were all these success stories. Like in the difference, I would say, with how I look at things versus how Bill would look at things is in kind of like what you were saying, Lee Tanner would say is, "Oh, well, no, Bill put in his book on page 237 that no, you can't do that or you have to do that." The reality is didn't follow his own book, and I it's true, and so I used to, and I made the biggest mistake in the late '90s because I was trying to get noticed by him, so I joined I was at T. Rowe Price, which is a mutual fund company. I was just in their customer service, let's call it, department from '93 to '97, and then I left there, took a pay cut to work for Bill because he did not pay much at all. And did I say at all? Like at all. And
Yeah.
he was known for that, and he kind of took pride in that. He was like, "Well, I don't pay people much, but you're going to learn the skill set, and then you'll be able to make it in the market." So every month I'd have to go, okay. I'd ask my wife at the time, my ex-wife, okay, how much money do I have to pull out of my account this
Well,
month to pay our bills. That's what
more debt.
it was what it was. It was there was no plan B. All I wanted to do is be a PM for him. That was the point, and it was a struggle. I forget where. So the point was, he at that point he only had his second edition, so the red book. So he had started off with the white book, which was the first edition hardback, and then the similar thing in the softbound, then the second edition. So he would change things every once in a while. And by the second edition, he was still into the small cap thing. So during the 90s, trying to get noticed by him, I did it exactly by the book. In my interpretation, anything that I did, I never deviated from the book at all, at least my interpretation. Now, I might have deviated it from it, but I didn't know I was. But my thing was I want to do it exactly by the book. And I didn't realize that he had already moved on from small caps. He didn't care
Yeah.
about small caps anymore because he didn't want to get trapped in them. He'd gone on to mega caps, and large, big liquid names. So I missed the Qualcomm, which he made the bulk of the most amount of money he ever made was on Qualcomm. And I missed that completely because it wasn't even in my universe. And I didn't do the Dells and the Cisco's and the Microsofts back then because I thought, well, Bill said in the book that it's the sweet spot. And that ended up working out. So I was, it all worked out. But I just say that to people who are that hard line about it because, I'm somewhere on the spectrum myself. So that comes with like it's pretty obvious, right? You can talk to me for 5 minutes. It's like, oh, where on the spectrum is he? So it comes with some strengths and
Yeah,
weaknesses. But
absolutely.
one of the things is black and white. I'm very black and white on things. Kind of think of it like Sheldon from
Yeah.
Big Bang Theory. Is like, okay, no, I can't process gray. There's no touch of gray, even though I'm a deadhead. Once I realized, oh, well, Bill didn't even follow his book. It opened up a world to me. That was like, you have to do the broad strokes. What are the broad strokes? Okay, the general market is everything. That's still super important. So you got to figure that out. And finding these growth stocks that repeat over and over and over again. That's another universal thing that doesn't change. And then managing risk, cutting your loss, trying to let your winners run. That's another thing. But within those core things, and then of course sectors and groups are important, and earnings and sales, and you can start going look the thing and dissecting it, but keeping it broader, like because he was hung up on return on equity 17%, so
Yeah.
16% would be a flaw. Well, there were plenty of 16% or 5% return on equity ones that worked. And once you can get past that and not be so dogmatic on things, it opens up a world to you. But some people, if you need the comfort of doing it exactly by the book for the first X number of years, that's probably the way to go. Like you need to know the rules inside and
Exactly.
out before you can change them. What are your thoughts?
Bingo. That's exactly how I see it. You need the clarity in decision making, and you should really just have a simple rule set to execute your plan. And what you're talking about with Bill and how he operated and how what he wrote down in the book, he didn't follow himself. I think you have a big part in channeling that a little bit better, giving more structure around with the 250 grows 250, and your input in MarketSmith, the market search, and how you have that on the spectrum more
Yeah.
black and white mindset, and the moving averages and the quicks and grateful death. Kind of like, what you said about, oh, you're you're doing research on something and you're coming out with some rule, and then somebody else copies it. You took this unique name there. And I think you were a great compliment to Bill in that
Well,
way.
Well, thank you. And so I did start putting goofy names on things or putting my own names on things because I got sick of people. What would make me the most mad would be I would come up with a concept and I would get a lot of pushback at first from everyone. And then ultimately, would take years. It would siphon through where now everyone just looked at it this way and no one ever said, "Oh yeah, Mike, you were right," or whatever. And then people try to school me on something I came up with. I had enough of that BS, man. I was like, no, I'm gonna put my name on everything I do going forward. I can't go back and say it's the Mike Webster composite rating or the Webby composite rating. That's the IBD composite rating, but it's Webby's, and I redid
Yes.
it. Or, the Growth 250, which I'm the most proud of this recent change that I did to them, which was my original, like it came from me, changed from me, and I did a revamp. Now, I'd
What a
love to
great,
put my name it is it's so good now, and I'm gonna make it better. There's still a few things I need to tweak on it, but I did a total redesign there as well as of all the ratings. But the rest of this stuff, like Quick Quicksand, Grateful Dead, I'm like, okay, I'm gonna throw my name. Maybe my name isn't on those, but anyone who says Quick Quicksand, Grateful Dead would just know it's got to be some dude out on the spectrum who's a deadhead, like is gonna
exactly.
name. There's stuff like that. But it's a more of a personal. I guess that's just irks me, or people talk about the 21 day constantly. But when I came up with that, I got so much pushback. And where is that? I cannot tell you how many times I heard, where is that in this book? In fact, in a PM meeting once, Bill got upset with us because it was in 2011 and the market had gapped down. It was like February 11th, I want to say. I could be wrong on the dates, but it had stalled and then it came down, and he was upset because we gave back a lot of profits. He's like, you guys were up X millions and then you gave that all back. Let's walk through what
Bill was up.
happened. Bill was upset with the whole team. The whole team. There was typically about 10 PMs, and he was upset with all of us because we had stayed in the market past when at the time there were 5 days of distribution. And he
You
would
got it.
go, he was at that point in time, he was hot and heavy on if you had 5 days of distribution within a rolling 25 days, you needed to be out of the market. He would say it like that, out of the market. Now, there were other times where you would be 8 days of distribution and he would have us on margin. That's why Chuck, Justin and I came up with the power trend, which is that whole concept to know like, well, wait, Bill's one time he's really upset because there's a lot of distribution. And then this other time there's a lot of distribution. He doesn't care about it. So our answer was go back and study the market and come up with black and white rules. And that's what the power trend came from, was kind of trying to deal with trading for Bill and still trying to have some rules that make sense. But I'll just tell you this, I don't think I've ever told this story before. In that meeting, he would go round robin, and it was like, man, if you were the first person to talk, you were really in a bad spot. And to me, that time, I happened to be the first person to have to talk because then you got the brunt of it. And then by the time I got to the last person, he had done his lashes, and he was, I'm just telling it the way it is, that he was kind of burned out on on ragging on us, and then we would get into a normal productive topic. But he goes, "Mike, and he brought in the CFO. He's like, I I see that on this day or some day in March, you increased your exposure from this to this. What were you thinking?" And then so we pulled up the chart and I go, okay, well, Bill, we were still above the 50-day. Whoa, 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 whoa. Wait a minute, Mike. Where's the 50-day in the book? So that in mind, he doesn't have the 50-day in the book as far as from the general market standpoint, but he would use it all the time. And I'm not throwing Bill under the bus. What I'm trying to explain is that you have to have a certain mindset, a certain amount of flexibility and an open mind, because there were other times where he would say things about the 50-day, the 200-day, not about the 21-day, not about the 10-day, because that wasn't something that he would use on a regular basis. But it's important to understand that there's the letter of the book that is so important. And it is the reason why I never, have it more than 3 feet away from me when I'm at my desk, because, even though I helped him with this version and the version before, I still use it all the time because it's gold. But you need to know when to throw out the stuff that's in there because he would. And it's such an
Yeah.
important thing because in our community, there's this rigidness that I'm trying to push back against of people like, no, Bill said this. Well, no,
Very good.
Bill said that and then he changed it. What are your thoughts? I'm sorry I babbled on so
Well,
long.
so the interesting part here is you witnessed him. You had an office with him. You worked with him 20 plus years, and you were able to take some of his flawed thinking or or the discrepancy between the
Yeah.
book and how we acted, and channel that a little bit, to some extent.
Yeah.
You don't want to fully channel it, and the students of how to make money in stocks, that ones are those that are too rigid and are taking it like as if they were in grade school or in high
Yeah.
school, where something is taught. And okay, so when was Civil War or whatever, there's a specific year that you can say the Civil War started, then it ended, then World War II, whatever. Can Slim, they treat that the same way. They look in the book, oh, what exactly does it say? Oh, I did 5 trades exactly how I'm supposed to. I lost money on 4 of them. We always have newbies entering our
Yeah.
groups. I see these people and they're like thinking that because they read the book, then they're going to make money.
Yeah.
And they forget many aspects. Like one of them would be the law of large numbers. I tell
Yeah.
people at the bare minimum, 200 trades before you even think of making an assessment about the
Yep.
viability of trading canceling. I did an experiment, about 4 years long experiment that we shut down about 6 months ago. The experiment was setting out to, the hypothesis was a simple, very simplistic hand slim approach with just a flat base, 4 weeks, 10% flat base, 4 weeks tight or whatever it's called. We only used those patterns. That's how we traded, me and 2 buddies. And after 4 years, we said we didn't outperform. We didn't outperform Ken Slim. We let it run for 4 years, just to say, oh, we were wrong. And so there's only going to be very few people, maybe 3-4% of all the readers of how to make money in stocks. Like there's with any book or with any technique that they actually like get the essence
Mhm.
of it, it's a tool to give you structure, to give you clarity in decision making. But what you have to be able to do is you have to be able to read between the lines. Now, what I specifically mean with that expression, read between the lines, is what applies to you. What
Mhm.
specific approach is really valuable here that will complement your trading, your investing in a really meaningful way. And for me, for example, the reading between the lines was the 7% stop. When I got that
Yeah.
clarity and decision making, always put that stop in, that was really valuable to me. And so the challenging part with investing with Can Slim with a structure like that is to tease out the nuances. And Tom Sosnoff is great there because with option selling, it's even more crazy. It's even more emotional. And then we're going to come back to that, as it is with a momentum driven strategy. And so coming back to Can Slim and or IBD, all that, the whole structure, and how it's changed over time. I
Mhm.
was really successful with Can Slim in the early 2000s, like 2002 maybe. I started trade. So in 2001, I read How to Make Money in Stocks, and I gave myself
Okay.
time. I never did this in my life before. I treated this as sacrosanct. I really developed my rules. I took, I think, maybe number 2 as well, the level 2 workshop before I started trading. And then I did small and mid caps. And Bill was already out doing the large
Yeah, the
cap and
large
eventually
cap, yeah.
mega caps. And the system eventually incorporated that too. IBD did. But what was I going to say about? Oh yeah. And then also the big picture. So I have a rule set around when to enter, and I can enter because my predisposition is I'm impatient. I'm really good at getting in, but I'm not that good at getting out. I'm the
Okay.
opposite of risk averse. Most people are risk averse. They shy, or they losing money inflicts more pain than the same amount of gain inflicts joy. But
Mhm.
I'm exactly the opposite, but I'm fairly neutral. I hate to lose out on an opportunity as much as I hate to lose money. With the big picture and the current outlook, it gives you that clarity. And when we had more trending markets and less computers messing with us, that was really valuable to be in a confirmed market, and then eventually power trend. But now, 8 out of 9 instances, you need to use the big picture as a contrary, whatever indicator is my opinion, especially when you work with options. With options, you only have to be a little bit right. You don't have to be fully or 100% right. And I can kind of bridge that gap between when the markets are uneven and not trending to when they started trending. So what a lot of people that read how to make money in stocks kind of forget is that even though certain principles of support and resistance and FOMO and, exuberance and a stock running up parabolically and these things always repeat, there's certain market mechanics where the machines have such prevalence to where you have to be really, really careful not to have a approach where you can be taken advantage of by the
Mhm.
market makers, by the algos. And so it's tricky to you have to really think the stuff through. And I think you're a shining example of that. You're not like the typical, like you got your CFA and you're this analyst and on Wall Street. And like I know you were offered a lot of money once to work for a competitor and you said no. And that's really speaks volumes about you, not like positively or negatively, but it just shows how passionate you have
Yeah,
been
well,
about.
I wanted to work for my idol. That's why I guess I don't have a problem with saying sometimes things that, taken out of context would be looked at as very negative, but it's like I passed up on a lot, life-changing, things to work with him, and I wouldn't have changed that because I got that experience that would have been you can't put a price on working with Livermore back in the day, or you
Yes.
can't put a price of working with Bill, and that's the lens that I looked at it through, but I also see him now, at first he was just this idol and this unobtainable person, but now I see him for everything, good, bad, and just like all of us have good, bad, and indifferent
Yeah.
in us. And it is I think what you're saying as far as find really is kind of in a nutshell is kind of like finding your what works for you, and it sounds like
Yeah.
you've found using these options as a way of getting an edge for you. So if you could walk through kind of circling back to where we were a little moment ago of you're in a time where the market is going up and so we're all hot and heavy on the market, but you're now going to sell these options. So walk through that because that's something that is probably is new to me, and I've never sold an option. I've just bought calls. So walk through your thought process there and how that works and how you like to do it.
Yeah, yeah. So it all started with the dilemma of what do you do when the market's not trending and or when it goes down. I'm not a short seller type. The only stock that I ever short sold was RIM, RIMM,
Yeah,
BlackBerry.
yeah. BB now.
Yeah, and it was even successful, but my mindset isn't there, so I can't do the short selling. And I'm also always thinking about, I've studied a lot of like behavioral economists and cognitive biases. These are just
Yep.
thinking fallacies. One of my favorite books is The Black Swan by Nicholas
Oh,
Nassim Taleb.
I need to what is that in a nutshell, the Black Swan
The
book?
Black Swan is all about tail risk. What
Okay.
what what he's saying is the unexpected event. The
Mhm.
very, very completely unexpected event that you have no clue will even happen happens more often than not.
Kinda like a long-term capital back in the day or
Y- That
9/11 or COVID or okay.
exact long-term capital management. They said, one in 2 billion years is we're going to blow up, one time in 2 billion years or whatever, and then they blew up,
Yeah.
2
Yeah.
years. So Tom Sosnoff is kind of like the counterpart to Taleb because Taleb, he had this fund. I don't think he has it anymore. That made him famous in 2008 or 2009, where they bought a bunch of way out of the money puts that had
Okay.
virtually zero chance of becoming valuable. But then the market moved so strongly against or so strongly down that their put
Mhm.
options went through the roof. And that was his claim to fame. So, anyhow, when I look at how people make decisions, they always fall prey to these fallacies, and one of the biggest ones is risk aversity. I'm just picking a really simple one that's easy
Mhm.
to grasp, because risk aversity means that because of our biology, we are hardwired to survive.
It
We're
makes
hardwired to
sense.
survive so that we can procreate. And, that's why we're here,
Mhm.
natural selection. And so our tendency is to be risk averse. If you could get eaten by that tiger, you better not go out and gather some food, wait for the tiger to go. We probably won't die of starvation, but don't go out when the tiger is around.
Yeah.
So what that means is that a loss, say death, the worst
Mhm.
kind, is way worse than gaining maybe some fresh honey or something, that you can climb up the tree because that tiger is around. You're not going to go for that honey right now. So because that honey will taste great, but if you're dead, it's pointless. So that's why we're risk averse. We weigh a loss more heavily than we value a gain. And
Yep.
that gives a disadvantage because an opportunity lost is just as bad as as a gain. An opportunity lost is just as bad as not avoiding a loss.
Mhm.
Meaning that I will kick myself if I see an opportunity. I say, okay, I got to go long now, and then I don't, and the stock zooms up. That is risk management, like going in the offensive. That's part
Yeah.
of your risk, meaning you're accumulating money when times are good. So anyhow, I studied all that, and then what I devised a rule set about 10 years ago that complemented my canceling trading. So the rule set is centered around volatility. When can slim is doing well, when growth stocks are doing well, and volatility tends to subside as we go to higher and higher heights, what happens is people get complacent
Mhm.
and money moving in, and it's our risk aversity speaking to us, among other behavioral fallacies. The neighbor is making so much money with these stocks. Oh, the newspaper's writing about it. Let me also go in now. And then that pushes the market up, of course. And that's when you need to start selling a little bit, little chunks of your
Mhm.
portfolio. If it gets totally crazy, sell a bit more, sell a bit more. And then eventually the market tanks sooner or later. And
Yep.
when that happens, I put my insurance hat on, like I was an insurance company. So I always kind of compare the selling of volatility to an insurance company. Let's say you are an insurance company, let's say Allstate, and you sold a bunch of policies on earthquake insurance in San Francisco. Now an earthquake hits
In 1907 or 1908?
today.
I'm just. It's a joke. Sorry. Sorry. Don't worry about it. Wasn't there a
So,
big earthquake in 1907, right? The earthquake in, San Francisco.
17, or then the San Francisco burnt down.
Yeah. Well, I'm sorry. I was just.
Oh, that's a good example. That's in 1907, big earthquake hits in San Francisco and everything burns down.
Yeah.
And you're an insurance company. You had insured some of these homes, now you have
Yeah.
to pay out. The prudent move for that insurance company, if they don't blow up, if they survive and they pay out these claims, the prudent move would be to be really aggressive now selling um, earthquake insurance or fire insurance, fire protection insurance, whatever they called that, because for two reasons. A, the chance of San Francisco burning down has just lessened because A,
Mhm.
these houses already burnt down, and B, the new houses that will be built, they won't be out of wood.
Yeah.
And so that's the one reason that the
Yeah.
probability of another loss has lessened. But the second one, the more important one, is that insurance premiums for earthquake and fire and whatever just went through the roof.
Yep.
Because
Big
now
time.
the houses that still remain, the owners of those houses, they're like, "Oh, I could have gotten hit by an earthquake. Or I need to increase my coverage. Let me call my insurance agent and have him increase the coverage. And I'm not going to care about how much he's going to charge for that. I'm not going to, ask him, oh, give me discount on that, because all I care
Yeah.
about right now, the very moment, is to save my house. But you don't have to
Yeah.
worry about it anymore. There's not going to be an earthquake for another year or two, probably. The probability of
Yeah.
another earthquake is very small. It's just lessened. But the earthquake insurance company can sell these policies at a fat premium compared
Mhm.
to a fat markup compared to a day ago.
Yep.
And that's what selling options is all about. The art form is, of course, to not get greedy and not go in and, when I say sell insurance on, say, earthquakes or fire, what I'm talking about is sell put options on different stocks, different ETFs, different commodities. And it's
So
a
let me
beautiful.
walk you through kind of a scenario because I want to make sure that I got the right picture in my head. So let's do it on a market wide basis. That the market has been running for a long time. It's it's in a power trend and it's been long in the tooth and it's everyone's complacent, everyone's printing money. This is when you're like, this is the time to start getting some insurance, and so you're going to be doing it there where the implied vol is, benefiting you in hopes that it's going to rapidly expand if we roll over. Am I getting that right? Is that kind of the
No,
the
no, no. So basically, when the market runs up, I'm basically primarily canceling. I'm just long,
okay,
more or less long. And if it gets crazy and VIX goes down to 15, 14, 13, I'm going to sell off more of my stocks. But that's just that
okay,
part. But then the volatility part is when VIX spikes above 30,
okay.
when you already start a little bit above 20, but when it's above 20 and VIX, what VIX is simply all the prices of the call and put options, not all of them, but a subset of all the calls and put options are tracked and based on basically the higher the prices on the put and call options, the higher VIX. The
Hmm.
more panicked people are and they're driving up put premiums and or the more excited they are and are driving up call premiums, the higher VIX. Typically, it's the put premiums driving it. And the put premium is simply, a put option is simply insurance against a down market.
Hmm.
So what happens is because of risk aversity, people buy puts after things crashed. So
Yeah.
when the market goes up and up and up, they don't buy puts. And I can't do anything there because momentum begets momentum. When things go up
Hmm.
and up, I don't play and say, oh, it's going to come down. I have no idea. Chances are
Yeah.
that momentum begets momentum. It's going to keep going. There's always a higher probability it will keep going than,
Hmm.
that there's always, if the previous day was up, the chances that the next day is up is more than 50%,
Hmm.
so that momentum, but it's only maybe 51% or 51.5. It's not 60 or 70. You can't really bank
Yeah.
on that. But when momentum based momentum, get out of the way and stay long. When it gets crazy, when it gets parabolic, start selling a little bit, but you don't know how much longer it's going to go. So you can't sell everything because you might, so sell a little bit, but move up your stops. And then when things go south, like during Liberation Day, that was beautiful because the volatility was relatively low, maybe the 18, 19 going in, maybe 17, I don't recall. And they completely spiked for 2 days, way off the charts, spiked over the weekend on the
Yep. Yeah. Yeah. It was a crazy time.
totally crazy time. And it was a gold mine for an option seller because I always say with selling, especially selling puts, you only have to be a little bit right. So when that happens, when the market sells off, say 10% in 2 days, like it did on Liberation Day, then
Hmm.
VIX jumps to 50, 60%. It can easily drop another 10%. It
Yeah.
can easily do that. And chances are higher that, because momentum begets momentum on the downside,
Yep.
chances are higher that it actually drop a little bit more. But the cool thing with options is you can sell them really far out of the money. So what I would do is just sell a 20% out of the money put, which means the S&P would have to drop another 20% for me to get hurt. And also, uh, 3, 4 trading days ago, that same put that was 20% out of the money relative to the S&P, I got maybe 50 cents, and now I got $3. I got
Yeah.
6 times for the same put. So I have to sell a little bit. I maybe sell just one put, but I have to sell something. And that's what my rule set is centered around. And so that's the most basic one, where you just sell when people get really nervous. And like Baron von Rothschild, he said, buy when there's blood in the streets, even if my own, like when they persecuted the Jews, he was Jewish.
Yeah.
He said, even, if they're going after us, I'm gonna be buying because everybody's in panic. So it's really safe to buy. And that's what the option piece is all about. And that's what we're teaching in this group. I have a beginners group and there's an advanced group. And let me tell you, Mike, I'm just not a natural born like trader or seller or option seller
Sure.
or stock buyer. But since I've been a kid, I've just been fascinated with it. And I've been so much trial and error. There's other guys, like I always mention Michael Nestler, who got it like that, or my oldest Tim, he doesn't have to, he's just naturally gifted, to get all this stuff. But I'm so flawed, and I had to really study and drill down that now I'm able to teach some people, not everybody. The ones that want a quick like answer, I can't because it's more nuanced.
Yeah, it
Um,
is it's a big topic. Let me walk through this way because I wanna be able to make sure that I grasp it. So, you're in a power trend, the market is ripping, it's up near new highs, the momentum is going. So with your stock only stuff, you're trimming some of that, but from the option standpoint, at what point, what is your trigger to you're saying, "Okay, I'm gonna start selling some puts." What is your are you always selling some puts, or is there a catalyst where it's kind of like on the flip side of if you're out of the market, you're waiting for a follow through day before you start buying? What is the catalyst that gets you to start selling some puts?
whenever VIX is below 20, I can't sell puts.
Okay.
I can't sell
Okay,
puts.
that's important. Okay, because I was grasping it the other way before. Okay, so you're waiting for
All you're talking about is Nassim Taleb. So Nassim Taleb, what he does is when it's super extended and everybody is just partying, he
yeah.
starts buying puts that are really for the money. When nobody
Okay, got it.
think of it, he starts buying. What I'm saying is you have to wait a little bit longer. Like this could go on for a long time. And Nicholas
Oh,
Taleb, he's gonna
okay, yeah. My headset was completely it was that way. Okay. So you're talking you're waiting for them to start getting expensive and you become the insurance salesman. So
there
the market is starting to curl. People are saying, buy me fire insurance. I forgot before. They're
you go.
paying up for it. And then that's when you're selling because you're saying, okay, the likelihood of my put actually hurting me is much lower than it was, a week before. Is that right?
Yes, and the likelihood is lower that I'll get hit. And second, I get compensated really, really well
Okay.
for selling that put. So it's both
Now
pieces.
yeah, I get that. That makes sense. Then you've got to just know the exact strategies of and the tactical things because whenever I do options, which is very rare, and like I said, it's just I'll be hot and heavy on a stock, and then I'll want to get a little bit more juice, and then I'll buy some calls, and that's what Bill would do too. He would very rarely, but if he was just up to his eyeballs in stock and he just wanted a little bit more, and that's probably the kiss of death, typically, really, myself included, because then you're missing something when you're that crazy about a stock that but that's my world of doing them, and even in that little world, the spreads are so big that you can't do your 7% stop loss because as soon as if you bought at the market, you're immediately down more than 7%. So it's a whole different world. So I would just, if the spread was, let's call it's $2 by 275, I would just start putting limits in between there, see if I get hit. If I don't get hit, and then I I cancel it and I go or I move it down underneath the bid, and then I keep going back and forth in between, and that's me as like a newbie with options. Um, how to tactically, what is a smart way of actually executing on your strategy? Are you doing at the market? Are you doing limits? What are you looking for things with big spreads, small spreads? How do you handle that?
So what you're talking about is friction. There's a lot of friction cost,
Hmm.
transaction costs with options. There's still commissions. You can negotiate those down with most brokers. Interactive Brokers has the lowest usually. But you can negotiate with them, but with all the other brokers, you can negotiate them down if you do a lot of them. But the friction part is really important because when you're talking about a bid ask spread of 2 to 275, that's huge.
Yep,
And that
massive.
and challenges such as using stop sell orders on on the downside, when you go long, a Tesla call, and then all hell breaks loose and it drops like mad,
Mhm.
you're gonna get bad fill typically, or just by its
Yeah.
very nature, the aspect is fairly large, and then there's a commission. So what you want to do is you want to take advantage of that friction, and I do that. I mean, it gets a little bit into the weeds because, and
No, get into the weeds.
I'm just trying to be principled, talking about basic principles rather than the nuances of selling option premium, because you
Mhm.
have the put side that you can sell, which means
Mhm.
when you put, you're obligated to buy a stock. You're really going long the market,
Yeah.
when you buy, when you sell a put. But then you can also sell calls, which means you do the opposite what you and Bill and especially Charles
Yeah.
have been doing. Charles is a madman. He buys, all
Mm.
these calls on Tesla. I mean, for his private account, not
Yeah.
not not for the
Yeah.
institution.
Yeah.
Institution is totally on the book. I get that.
Yeah.
And that's great for like your momentum hat. It's great when you can do that and ride the train as long as you have an exit point and you pull the plug really quickly. But then there are additional strategies where it's almost like too good to be true in some sense, where you can sell a call and a put.
Mhm.
And that's kind of the niche that I've kind of went into the
Oh,
past two
okay.
to three. Yeah, there's whenever there's a crazy chart, like silver was one of those recently,
Oh,
that
yeah. That
just
was a crazy
goes
one.
like that. When it
Yeah.
goes like this and then parabolic, there's nothing I can do with options. And I,
Okay.
I don't want to, I don't want to, there's nothing, I just have to stand by the side. But I
Okay.
watched that chart. And then in January, one day it dropped around 30%.
Yeah.
And that was like the gun that went off. Like, okay, wow, now it's safe for me to do it. Then I did a strangle, which means, and I did it on SLV, Sierra
Okay.
Lima Vic. That's the silver ETF. And silver, until
Yeah.
last year, did anything exciting. Neither did gold. Implied volatility for gold was always around 20, and for silver maybe 25. And then implied volatility on silver jumped to 100,
Wow.
like four times than usual. So when
Wow.
that happened, it went parabolic and then
And
it
I
pulled back.
remember trading silver at the time. I mean, that's what everyone and their brother was talking. I mean, gold was
There you
running
go.
too, but silver was freaking berserk. It was just and,
Exactly. So
yeah.
then it pulled back like mad,
Yep.
and which means volatility stayed super high, and that's when it became safe and very attractive to sell a strangle. So I did. It dropped to maybe 85, the SLV. So I sold 110 call, which was the previous high, like the day before, and I knew it's not going to hit
Okay.
110 for months at least, because
Okay.
that was a really hard hit. A 30% drop,
Yeah.
it's gonna take a long time to fix that. So
Yeah.
the probability of it hitting 110 was like 1% in my view. And then I sold like a
Mhm.
60 or 65, because I mean, like, it's not gonna drop that much because a lot of silver bucks are gonna go in. It's just for the opportunity
Yeah.
that they were waiting for.
Yeah.
And so I got compensated really, really richly on that trade. It was almost
Okay.
too boring of a trade because it just didn't move hardly any. I mean, on a daily basis, it did, but overall. And so that's kind of what I specialize in now.
Can we back up a second because the terminologies on and I make fun of it at work because they always talk options and I just like decide to just tune out with the strangles and the butterflies and all of these things and that for people who are really into that they should go and either go to that Friday event or go online and watch it and with you and Tom and everybody. But I'm just curious, the strangle, could you define that again? And then also really where where do you make the most? Where is your, because you're defining your risk at using those, I would assume, so you know your max
Yeah.
risk. Well, walk through that on a very, very, very basic level for somebody like me who doesn't do anything other than in the option world, just buying a out of the money call on something that they're crazy about.
Let me break it down to its essence
Okay.
about where I see. the selling of options. Okay, so as economists, there is no free lunch. There is no
Mhm.
$100 bill on the ground because somebody would have picked it up already. So a
Yep.
$100 bill on the ground doesn't exist. You can't go to a free lunch because there's always some opportunity cost. Maybe it's insurance salesman wants to sell insurance. He invites you to a free lunch.
Mhm.
So a free lunch does not exist in nature. I mean, a windfall is a free lunch. Like, if there is a big hurricane and, the hurricane grabs some $100 bills and drops them in front of you, that's a free lunch. A windfall is free lunch, an
Where do
unexpected.
I stand for that? Because I would love to be just standing there and having it like, I'll just take $1 billion, just to drop $1 billion. Could you get the weather going for me there?
So here's the thing, Mike. There are free lunches around. They're very rare, but there are the free lunches and you have to grab them. You always need to grab the free lunches, and that's what my options selling is about. And
Okay.
this is where Sosnoff comes in. So one free lunch is when you sell a call and you sell a put,
Okay.
you will win on one side. Either the stock goes down, it goes up, it goes
Yeah.
sideways. If it goes up, you are guaranteed to win on this side. If it goes down, you're guaranteed to win up here.
Mhm.
So, so there are certain no-brainer option strategies that you can apply with your existing portfolio to increase your risk adjusted return. Not guaranteed, but almost guaranteed. And what Tom Sosnoff talks there about is you can diversify and increase your risk adjusted return with non-correlated strategies. And one of the market wizards, his last name was Larry Height.
Oh, yeah.
He was,
Yeah, a legend.
yeah, and
I
he
think
was
he's
like,
out is he out of Pennsylvania? I think? Philly? I could be
I
wrong.
believe
Doesn't
so. Yeah, he's not traditional like New York and stuff. And he was also kind of more like you, like unconventional. He was like a music promoter initially and kind of
Yeah,
stumbled
I
on
think
trading.
something like that, yeah.
Yeah, Larry Hite was all about using non-correlated instruments and
Yeah.
non-correlated strategies to end up with a relatively smooth and very high risk-adjusted return. So I use options for that, and there are. I mean, I had a massive free lunch, my biggest one, handed to me 2 weeks ago.
Oh, what was that?
So remember the meme stocks, GameStop,
Yeah,
and GameStop was the
and then
main
that
one, and then the
games at AMC, and then recently we had that
GameStop
one with
was
that car, the Avis. Avis did that crazy
yes.
move.
So Avis was the one that I'm referring to that was really
Oh,
tradable for me because a GameStop I couldn't really trade. I did, GameStop went totally parabolic
yeah.
and completely erratic and implied volatility when I think it approached 500. Like VIX
Wow.
is 20. That
Yeah.
all time
Wow.
high of VIX like 82, but this at
Wow.
500. So it was. I had to sell. I sold one GME call because it was so completely ridiculously high, but
Yeah.
at the same time dangerous. CAR Avis, it went through a completely crazy. I mean, you can pull up the chart maybe.
Yeah, I was just going to because I think that that'll be a good
That for me, my personal trading experience, that's like my number one like experience that's going to go into my history books. I mean, this was my most successful trade, but it was also if you can do like daily and go back to just go back day by day, maybe go back
sure.
like 6 days, because that's not just a lesson in options and options selling, but a great lesson in psychology and also, that's perfect right here.
Okay.
Also a lesson with GameStop. What happened was the big guys really squeezed by the little guys. That was one of the very rare instances when that happened. So, with car, what happened was, you can go, let's see, what was
Go
this?
forward?
Go one day forward and one more day.
Okay. Let me just keep going until it tops.
Okay,
See
perfect.
where
That's you can see right there. Go one
okay.
day back.
1 day back? Okay.
Yes. So this is what's referred to a gamma squeeze. So what happened was this one company owned 50% of car, and they were also, that company is also running the head of that man, the head of that asset manager is also the president of Avis. Okay, so they were
Okay.
restricted. They couldn't buy or sell. They were just kind of holding the stock. And then some other firm, I forgot their name, started accumulating stock. And neither the first firm, the majority owner, nor the second one that started accumulating were lending out shares for short sellers. So Avis had
Yeah.
so Avis had some write-offs recently for their electric car fleet, and they're not really very well run, and so there's like no chance that it will be taken over or that the stock is going to skyrocket. It's just kind of boring. So, but because the second firm gobbled up shares, the stock moved up, and the first firm held on to theirs. It moved up and got to ridiculous levels. It got, within a month, it moved up like 300%, went from 100 to 400. So the short sellers said, this is completely ridiculous. And you can see volumes just going through the roof here. They're like, okay, this
Yep.
is ridiculous. I'm shorting. The rational thing to do is to short here, and they got even higher. They shorted here, and then they got squeezed. You can see this massive, massive volume, especially on this day. They're completely squeezed, and this is now called a gamma squeeze. And that's the a massive, massive free lunch was handed to me the next day. So what happens here is the short sellers,
Can
they
you,
could not.
as a buddy of mine is big into the gamma squeeze, and he's an MIT dude, super smart guy. Could you, and he's way into that, and I know people who get way into that. Could you just do it on a very basic level, to
Yeah.
explain the gamma, and then the gamma squeeze option, aspect of it? Because I agree with you. I do think that, yeah, that aspect is very important. We're seeing more and more, of that. So could you explain that? The
Okay.
gamma squeeze?
Um, can you hear me okay, Mike?
Yeah, now I
Because the
can. I
connect.
think we went out.
Okay.
If you couldn't hear me, what I was saying, because, and I'm sorry, I'm still having issues, with my internet. If you could just explain to people on a very basic
Yeah.
level the gamma squeeze, what a gamma is,
Yeah.
and the gamma squeeze, because I think it's so important.
Yeah, exactly. So the gamma squeeze is an instance of the tail wagging the dog. So what happens around here is the short sellers, they're getting squeezed out, and so it's just a normal short squeeze. But then um, some of the short sellers, to protect themselves, are buying calls, and And what that does is whenever somebody, and that was really the case with GME, when you buy a call, and the market maker sells, and when you buy a call and the market maker sells it to you, they're offsetting some of the risk by buying stock. So anybody buying calls, it's the same impact as buying the stock. So people are buying calls like mad here to protect themselves. The short sellers are protecting themselves. The speculators here, quickly turned to the meme stock. They saw this going up. They're like, okay, it's going to continue. I'm going to buy calls. And what that does is it makes the call premium and the put premium extremely expensive, because it's a feedback loop. So what happens is
Oh,
people, the short sellers are being squeezed, or they're buying calls to protect themselves, which makes the stock go up even more, which makes the call buyers even more giddy. They're buying more calls. And a lot of these call buyers, especially the meme stock crowd, has no idea that they're way, way overpaying. And that even if the stock goes up a little bit more, they will lose a ton of money on their calls. And if the stock goes flat, they will lose all the money within days,
mhm.
because they're
Yep.
overpaying way, way for that.
Yeah.
And but the thing
Mm.
is, some of the participants have no choice. Like the short sellers, they had no choice. They were backed into a corner, and just by them closing out the position, it made the stock go up even more, and the call buyers get more giddy. And the gamma squeeze just means, I'm not going to go into the details, but it makes those call options and the put options extremely expensive, at to ridiculous level expensive, which means you have to sell a call, or to put another way, you can't not sell a call, because it's a massive free lunch. If you do that over many iterations, of course it can go up more. You don't know. But if you do that over many iterations, you do just a tiny bit, because you can blow up if you do too much. You just do a
Mhm.
tiny bit. Many of these no-brainer trades, this is called an asymmetric trade here, which
Mhm.
means that the payoff, the potential payoff, is much, much higher than the risk you're taking. So, did that answer your question about the gamma squeeze?
Yeah, no, it did. I mean, I guess the way my buddy always explains it to me, as a non-option guy, and you can correct me if I'm wrong on this, is that with because of the gamma squeeze, that basically the market maker has to, when they're selling you the option, so you're buying this out of the money call. At this point it was seven,
Yes.
trading around 750, and then someone wants to buy something at 1,000 at that point. Well,
Yes.
the market maker will sell it to you, but then they have to go in on the other side and actually go in and buy the stock to neutralize
Yeah.
themselves,
There
because
you go.
they're not trying to play one side or the other.
Exactly.
They're the market maker, and the mechanics that you're talking about, the free lunch, is you're trying to benefit from them forcing it. And the key here is
Yeah.
the limited float of what you were talking about at the beginning,
Exactly.
was that you don't have a lot of shares outstanding that can be borrowed from the short side. Because
Yes.
people don't understand is you have to, if you're going to short, those shares have to be like, if I'm long, I can decide to lend or not lend those to you. And if you really want them, I'm going to charge you interest on it. And I can charge you a crazy interest,
You probably paid
massive.
80 on car to short car, you probably paid 80%.
Yeah. Yeah. And people were willingly doing it because for a while there, it made sense. But if you were someone who was just owning it and you believed in the company, like, and that's the trick, is if you actually really believed it, yeah, you would be lending out those shares, but the smart people would probably be like selling, going like, anyway, I didn't mean to distract, but would you say
No,
that
no,
my understanding
that's
of
exactly
that is
it.
relatively accurate?
Yes, but let me finish the thought now, because this
Sure.
here, it's run up. There's nothing I can do. This is a cowboy type
Okay.
lasso, swinging and riding the wave.
Yeah.
It's not me. I can't work with this chart. So on the evening of this day, can you click on that?
That's
The
the 21st. You want
last
me to
candle.
go?
Yeah, just no, just click on that last day. Just click, and I just want to
Oh, okay.
see that date that was. Okay, that's 21st, you say. Okay. And,
Yeah. The
and
20.
so somebody posted something in my group about car. I did not follow this. It was not on my radar screen. I update my like option screen once a week. I had not updated it. And I look at this, and I looked at the implied volatility, which was 240 approximately at that time. I'm like, this is totally, completely, utterly ridiculous. Tomorrow I have to sell a single call, just one call. You can get hurt, but this is just, yeah, gamma squeeze all over. Then let's click to the next one,
Sure.
22nd. So then in the morning, it went up more. It went from 760 to 847 up here. So I was scrambling to raise buying power, because I'm like, this can't be. This is too good to be true. This is a complete parabolic move.
Yeah.
So typical. Now it hit the airwaves. Now the crazies go in and they're buying calls and they're buying the stock because they just think it's going to keep going. And so I was scrambling to raise buying power, and I would have sold somewhere above 800. But by the time I started selling calls, I just sold a single call. The stock was at maybe 780. It was still up for the day, which was awesome. And implied volatility had jumped from 240 to 270,
Wow.
completely nuts. And on the way up, implied volatility always jumps on the way down, but here it jumped on the way up because people got so greedy. So what happened was, the highest strike that I could sell, because I wanted to sell something like 100% out of the money,
Okay.
because,
Makes sense.
it could go up another 100%. So I wanted
Yeah.
to sell the 1500, but there was no 1500 available. The highest strike was the 1120s,
Okay.
11, it was 1140s. So I sold the 1140 June call for $180 or something. I shared this all with my group. I did a recording on that and showed all the
Wow.
transactions. So I sold a single option on a $750 stock for, $180. Completely insane,
Who's
which means the
who's on
stock
the other
had
side of that
go.
trade buying it from you, man?
Exactly. Okay, so there can be no rational person on the other side of the trade. It can only be the
Yeah.
market mechanics that would
Yeah.
execute that trade, you know? And it may be some crazies on the spectrum, on the wrong side of the spectrum, that will take me
Yeah.
up. So I sold the first one at 186, I think it was, which means the stock would have had to go up to $1,200 by June for me to just break even, and it would have had to go up even quite higher for me to get hurt because I received a fat premium. So that was
Yeah.
like in a $450,000 account, and that's huge. That's like 4% of the account value. I would never be that aggressive selling options. So the stock started coming down, and I just kept selling the 1140s, and then I moved to the 1140 August. That was the high. That was the next option available. So I moved to the August, and I moved to the June 900s and the June 800s, and the stock just kept going down. It was way too good to be true. And I just kept selling calls and selling calls because the market mechanics were such that it's now game over. As soon as it hit
Yeah.
that 840 and started coming down, it was game over. That it unraveled the other side. And just my selling alone, I mean, I sold, few contracts, but my selling alone, it's like a bunch of other selling calls. Just was the
Uh-huh.
self-fulfilling prophecy. And then, yeah, lo and behold, the next day, so here it dropped 38%. The next day it dropped 50%. And so I sold more here, but the game was already over. I sold more here, and then the next day was down 4% from that. Look at the volume. Look at that volume when it dropped 50%. It's just off the charts. So, and then fast forward one more day, and all the while, implied volatility dropped and dropped, which means my option premiums, they not only collapsed because of passage in time and because the stock was down, they also collapsed because implied volatility is just dropping like mad because everybody's trying to get
Oh, yeah.
out of their positions. And so now, I fast forward one more day.
I can go forward a little bit more if
Perfect.
you want.
That's good. So basically, on the 22nd, so after the big sell-off on the 22nd game, the game was over, and now it's a strangle. I converted into a strangle. I now sell the 100 puts. Stock is at 190 or whatever right now, and I sell the 100 puts, and I sell the 400 calls. It's no longer the same opportunity now. The gamma squeeze lasted one day, really, for me, like 2 days. That it was tradable for me. But
Well, that was
that's
a
like a,
dude, that was a monster freaking trade on your part, and I think it's
it
just
was,
great that you knew what to do, and you saw that there was this rare thing, and proof that the efficient market theory, is BS because that would have uh, suggested that the option market was priced right as well as the price of the stock, and it clearly isn't the case when you've got the market
well,
mechanics.
this is, when we talk about regulation and such, I'm more of a libertarian than anything else, but, here, it's just brutal for the ones that are on the wrong side of the trade because just structurally, when you can sell short and then somebody can grab all the float and everything, there's going to be some failure, especially when you're big, and that happened to in at the case of GME as well, where all the small
Mhm.
investors ganged up against the one big hedge fund, that
Yeah.
the small investors lost in the end, because Robinhood put a stop to it. But this is just an instance where my specific knowledge and me going through GameStop really, really helped me to capitalize on an asymmetric trade. And I sold so many options. I manage, I have some partnerships with people under the minimus exemption. I still manage money, but non-licensed, I can manage up to 5 accounts in California. I can't hold myself out as an investment advisor, but I was so busy
Oh, that's
selling
probably a good
options like
this is
mad.
probably a good opportunity for me to say, "You're not an investment advisor, I'm not an investment advisor, this is not investment advice. If you would like investment advice, please go and do your research and find a good investment advisor." Sorry, I forgot to, say that earlier. Would you, say that this GameStop that you were talking about, this is back in '24 and that spike up there, and
Man,
then it go again? Would you say that that was pretty much your precedent that you were using for the car? Would that be
so
fair?
I studied this inside and out. I don't know how many hours I spent on GameStop, but at least 50 hours researching the background of it, what led up to it, and how it all unfolded. And interestingly, Charles Harris's daughter and her boyfriend, they were part of the meme crowd. And
Oh,
they were
really? I didn't know that.
told me about, how they played it, or I don't know if they made money in the end, but he told them, hey, this is stupid. You got to sell these calls now. I don't know if they did or not in the end, but this is beautiful study of pure human psychology and market structure. And I remember exactly this totally crazy day when it went up 249%, I think it says here. Um, yes. Yeah. So that's when I sold my first call on GameStop, and I sold the
Wow.
90 call. I sold the 90 call when the stock was maybe 50, because it got just so completely ridiculous. That's like a technical term. Like the ridiculousness
Yeah,
level is so high. It's such a screaming asymmetric trade
yeah.
that I had to sell a call. And then I also started selling puts. I sold like the 15 put down here, when the stock was at like, I don't know, 50 or 60. You never get
Yeah.
anything for $15 put, but here you did, because it was just, that was probably the highest implied volatility on a legitimate stock ever. 500 implied volatility. So this is today. I could play this. Back then, it was impossible. I mean, I played it a little bit, a very tiny bit. I played it because it got so ridiculous. But today, I could play this a little bit better. But it's look at this aftermath. Like, so it
Yeah.
jumps to the
What's tricky is how would you have handled, 'cause it's looking to me, it's looking a bit like let's go to the date that, hold on a second. Shoot, 1 sec, 5/24. So to me, that the car looks kind of like reminiscent of at this spot before it goes for that bounce that then it's going to go again. And I should say I'm recording this on May 3rd, 2026. We probably won't release this episode until June or July, so it'll be interesting to see how this plays out. But to me, this is somewhat like where car is right now. So what did you do at this point, or forget what you did. How would you say textbook in your style at this point? What would you do? Would you neutralize it by doing the other side? Would you, how would you walk through it at this point and
so
forget that you know what ends up happening?
exactly. It's pretty simple here. You go, what Tom Sauce would say is go small and go really far, which means you would sell a call, like the 100 call, and you sell the 15 put. That
Okay.
way, because afterwards it got so crazy, you would think now it's game over. You would think, looking at this, you think there's no way it's going to go back, because a lot of people got hurt on the
Hmm.
way down, the stock call buyers. So you say like, oh, it's game over. I'm going to sell a 25 call. But then look at what happened afterwards.
Yeah.
So afterwards, some of the short sellers got hurt again. There was a second like coming. And so before the second run up, I would have just sold. I did. I actually did sell a call. I sold the 90, I think the 90 call or the 100 call or something when the stock was around 50. And just one, just a single one, So even if
Mhm.
the stock ran up 500, I wouldn't blow up. I would maybe lose 3 or 4% of my account. So, but you have to trade this. If, as an option seller who wants to get a little bit of a free lunch, you have to trade this. But the beauty with options is there's so many shades of gray. So if you're too scared, well, then sell the 150 call. If you're too scared, sell the 170. If you're still too scared, go out another 2 months and still sell the 170. But for heaven's sake, do something. Because the premium that you receive are so completely ridiculously high that a degree of irrationality has now entered, and the not the wisdom of the crowd. What's the opposite? What's that book that the guy wrote in the 1600s or 1700s? The
Oh,
madness of crowd.
yeah, yeah, yeah.
The Dutch tulip mania and all that.
Yeah.
Uh,
Yep.
that completely goes off the rails, and fear of missing out just grips a large portion of the population. And it took on a whole new dynamic with these Reddit feeds,
Yeah.
now it's the bets, Wall Street bets. It's still around. I read these feeds. They had car in there as well, but you have to be extremely careful. You have to be extremely cautious, but you have to also be like with car. I was super aggressive. I was feeling really safe throughout because I only started with a single call, but then it's just I made so much money in such a short period of time without being reckless. I felt.
Well, that's great, and we just moved back to car. So a few things that I would just point out, and again, who knows how this is going to play out, but just something from a non-option world and interpreting a stock. I would never touch this, in this position because it's not in my wheelhouse. Like I don't have an edge here. But if I was looking at this objectively, to me, it does seem like a a bounce up here to 400, maybe 500, especially using the GameStop as a potential precedent, uh, would be logical. And one of the lens that Bill would look at things when they decline are that you're starting to the selling pressure goes away as the moves get smaller. And once you hear it, it's like, oh yeah, it's very obvious, but it was something that he would say often, and it made so much sense. And it's with his heavy volume without further price progress was his way of doing things. Is so you come down this first day, you're down 37%. Then your next day, you're down a lot, but you're down less, or you're down wait, what was
You're
it?
down more the next day even.
Yeah. So down
Uh,
37%.
Bottom, you're more. If you take the whole
Yeah.
candle, you're
Yeah.
you're
Then you're
definitely down.
down. Yeah, 48%. And yeah, you're right. If you look at the peak, how much you were down. But his concept was then once it starts getting smaller, so that decline could be you're coming down 5%, then 10%, then 15%, then 20, you know, but when does it start getting smaller? And it starts getting smaller on this day where yes, it was down a lot, down about 11%, but it's starting to get support there. And
Yes.
then ultimately here it's down, only 0.5%. Well, that's supporting action, but it's supporting action from a lens of an IBD standpoint or a bill standpoint. We wouldn't touch this with a 10
Yes.
foot pole, but at least then it gives you for your option trade to massage your exit going, okay, well, most likely this bounces up. Maybe it just bounces up to 300. But if it were going to bounce, this is where you would assume, especially since it got support at the 200-day, which there's some market mechanics around that too that come into play, and then ultimately roll in a big way or flatline, kind of like what we saw in car or in GameStop or AMC. What's your interpretation of what I just said, and how would you look at this now?
Going forward, I have no idea. I have no clue. Honestly, I can't. I
Did you
can't make an
watch
assessment. This is too erratic. I'm really familiar with the conventional patterns I learned through IBD.
Mhm.
W, cup with handle, saucer, cup without handle, flat tight, and so on. But here, eh, no
You're
idea.
right. Anything anything can happen is also why I'm not touching it with a 10-foot pole because I would have no edge, and that's I think this to summarize what you're saying, my interpretation of it is you weren't trading it on the way up because you had no edge. You're not trading it now with any new things because you don't have an edge there. But where you had a massive edge, a free lunch edge, was up there at the top. And you're like, okay, this is too good to be true. You could define your risk. You knew how much risk you were taking and you sized it right depending for your account. And it really paid off in a big
And
way. I mean,
here's the important part.
okay.
The deciding factor is I got a massive, massive premium for the risk I took. The risk I thought was relatively little, but it was, I got compensated an insane amount of money, and that's why I did it.
Well, that goes back to your asymmetrical trade thing that
There you go.
we're always looking for. Well, that was fascinating. I really like you walking that through that. And while you were talking, it just reminded me something that for folks that you know, but newer folks might not know, this is nothing new. This is market mechanics, and this is in Bill's book on page 12, Northern Pacific, and people
Oh,
should
well.
go back. And that was the short squeeze of all short squeezes, and those was before there were options. But it goes back into the whole float thing you were talking about. They should also go back and study the tulip bulb thing
Yes.
because that is
Abs- I
so
studied that.
important. Yeah, that
Yeah.
is isn't it fascinating? Like, I mean, people were mortgaging their houses
They were
for
paying
one tulip bulb.
most valuable tulip. They paid as much as a decent single family home.
Yeah, for a tulip. You have to once you realize that, you take everything with a grain of salt. You go, it's not like, "Oh, well, those people in the 1600s, so they weren't bright." No, they're the same as just your analogy with, like, the tiger back in the day, tens and millions a year, whenever it was, because there's debate about that, and I don't wanna get into that, but
Yeah, no, I was
that
making that up
yeah.
kind of like,
Yeah, no, but I get what I get where you're going there. So, this doesn't change, and then you also brought up silver earlier. In the late '70s, there was a squeeze in silver with the Hunt brothers.
was yeah.
And, people just need to go back and study market history. Then they'll be able to put things in context and go, there's
Right.
nothing new. It's just there's changes, things that now there's the option world. If it were up to me, if I was a regulator,
Mhm.
I would not allow options at all. I would not allow after hours trading, pre-market trading. I would not allow inverse ETFs on individual
Any
stocks. I'm a
any
purist.
leveraged ETFs, any
Yeah,
leveraged ETFs, almost all of them approach zero over time. It's brutal for the
there's
individual
yeah.
investor. I would ban that, honestly.
Yeah, there's going to be a day when if you remember the flash crash, well, I know you remember, but folks watching, if you remember the flash crash, what was it, like May of 2010 or something like that, that when all the bids walked away on even things like Johnson& and Johnson and Procter& and Gamble and just Campbell Soup and just quality, not stocks that we would trade, but just quality, like value type stocks, that was market mechanics. And now there was talk recently about doing a 5x individual stock ETFs. Well, who is in charge, man? Like,
I
do
read
they not
that.
know what is going to happen? Like, if that ends up passing, when the day comes, and you talked about the VIX, people should go back and study when that VIX instrument blew up in I think it was like January, February of 2018 where the market had been running steadily for a long time. VIX was low and VIX instruments were getting, out of hand and everyone was and their brother were thinking about ways of capitalizing on that. And then one of those instruments blew up and it brought the market up in a parabolic move. And then when you have a parabolic move, they always end the same. The mean reversion ends up happening. Then they play out however which way. It works on both sides, just like Same thing happened in 1987. On the flip side, parabolic move on
Yeah.
the way down, then it has to spend, 1988, you know, reversing part of that. People need to go back and study history and you'll get a sense. But the fun way to study history would be to watch that GameStop movie. Did you watch that with the roaring kitty
I did, yeah.
character? Yeah, I went to the movie theater to watch it, and I never go to the movie theater because I just found it so fascinating in just a
I've
study of human emotions. And one thing I kept on thinking of when you were talking earlier was that everyone should ask themselves this question, and there's not a right or wrong answer, it's just a right or wrong for you is, would you rather be in a trade wishing you were out or out of a trade wishing you were in? And if you really think through that, it kinda tells you a lot of which strategies you would wanna take, and again, there's not a right or a wrong, and some people are a little bit of both, like, I'm a little bit of both. Where would you be on that? Would you rather be in a trade wishing you were out or out of a trade wishing you were in?
It's shifted for me. Used to be always the opposite of risk averse. I always wished I was in a trade that I wasn't in, and as opposed to the other side. So I was for a long time the opposite of risk averse, risk seeking, I guess. I
Okay.
always hated it. I wasn't in a stock that was going up. Now I have a little bit more of a measured approach. I try to behave like the billionaire that plays with 1 million of his money.
Yeah, that's
To
a
be
good approach.
I practice Alexander technique, or I'm not like a like hardcore practitioner, but Alexander technique teaches
I
you
don't
to
know
be.
that. What is the Alexander technique?
It's all about the process, not the outcome. It's all about subtle changes. Uh, it was this guy FM Alexander from Australia who always had stage fright,
Okay.
and it's about centering yourself. And it like one mantra is shoulders back, but you don't go like that. You only think it. It's just like back, or like,
Okay.
or I'm a runner, and with the Alexander technique way of running is up. It's an indirect
Oh,
way, even though you're going forward, you're thinking up,
uh-huh.
which makes you a little lighter on the feet, which makes you
Uh,
run a little bit more efficient. It's just subtle changes. And another simple thing is when the phone rings, I
mhm.
love to be on the phone. And when the phone rings with Alexander technique, you're just like, oh, the phone is ringing. Let me take it. Without the Alexander method, it's like, oh, the phone's ringing. Who is it? And
Interesting.
so with what it means for trading is I can just observe and not make an immediate interpretation, just observe and remain calm and just imagine, oh, I have 1 billion in the account. Here's 1 million I'm playing with. Who cares? It's a game still. I want to maximize that
Yeah.
million just because it's a challenge. I want to maximize that, but there's nothing at stake that makes my life different other than being a very disciplined trader. And I'm still in that journey. And it just feels really awesome when you're in control. Like with the car trade, I felt like really like, wow,
That
I
was an
know what to do
awesome
here.
trade, dude. That was just an amazing trade, and this has been so much fun. I just looked up at how long it's been, and I know that you're in a totally different time zone. I don't wanna take all your Sunday from your family, so we'll start wrapping things up here in a second, but is there before we move on to the stock stuff, and while you're talking, I'm gonna just put up the info on the Meetup, thing in San Francisco. So again, on Thursday in San Francisco, you do some with a select group of people, you do some touring around of the San Francisco area. On Friday, you have your option thing where Tom is going to be there. I'll come in the later and hang when I'm done working, just say hi to folks. But on the that Saturday and Sunday, I'll be there and I'm going to do a question and answer thing and talk about market surge, or that's what the topic is right now, or the changes, like what I did with the growth 250 and pattern rec and the ratings, those types of things. But uh, so I'll put that up. But why don't you maybe talk about that again? I know we talked about it before, but sometimes people don't watch the whole episode just to make sure that they know what's going on there. And if there's any other last words that you want to say about trading, any advice there, feel free to do that. And then there's this one thing here that we haven't talked about. Maybe you want to discuss what this is.
So yeah, on Thursday, October 2nd, we have the options event, and this is a website that kind of ties into it. I have two WhatsApp groups that are tied to this website, centered around selling options. One beginners, one advanced. I do a weekly call for the beginners group, and you can get resources here. It just went live today, so I'm going to update this the next week or two with additional information. But here are some resources for the options sellers. It's just centered around that. And then, but the main event is the Growth Stock of San Francisco meetup on October 3rd and 4th. Tom Sosnoff will be on both events. He'll be the main speaker on the second, the art of selling options. And we'll have 2 or 3 more speakers also talking about the topic of selling options. But then Tom will also speak briefly on Saturday morning, the October the 3rd.
Oh, he's going to be there on Saturday too. Okay, I didn't know that.
Yes.
That's great.
Yeah, we'll be there on Saturday as well. He said he's going to leave in the afternoon at one point. So we'll be happy to talk there as well. I don't want him to take all the limelight, but since he's there, he may as well say something.
Yeah, when a billionaire walks into the room, let him take the limelight, man, because that's where we want to all be, and then we want to learn from that. So I think that's
He has a unique brain. So
yeah.
so yeah.
Well, that's wonderful. We're going to switch gears into the market thing. This is where, I would highly suggest that at least people, if you can't travel there, let me share the one with the Zoom. It's all at the same place, but I know if Bill were around, he would be loving this. I could see him even traveling up there to do it. So your gross off investors just go there, and then you can click around to all the different things. I'm sure just reach out to you if anybody has any questions. But in summarizing on the stock side, I'd like to ask these questions. If you were going to give just a couple words of advice to someone who's brand new, meaning been trading less than 2 years, what would you tell them? And someone kind of intermediate, maybe 2 to 3 years to a decade, and then finally someone who's been trading, quite some time. So with the newer folks, what would your words of wisdom be?
So for the newer folks, I would really take your advice of starting small. I would first really focus on the low hanging fruit. I would dollar cost average into SPY or another index fund, maybe NASDAQ index fund, via preferably through your retirement plan at work or through an IRA. That's what I would start off with. And once you have a sizable account, let's say at least 10,000, start, with the growth stocks. I would definitely read all the books your recommended reading list, how to trade in stocks, how to make money in stocks. Instances for me, reminiscences of a stock operator was even better than how to trade in stocks, even though supposedly it was some journalist, but that one is just so fundamental, I think,
Mhm.
especially talking about momentum. And then I think the main thing for me is non-discretionary rules for the beginners. A non-discretionary rule is a rule that you have to follow. And what really helped me was Trading in the Zone with Devising My Trading Rules by Mark Douglas.
Yeah, that's a
And
good book. That's a really good book.
in general, I think people go too fancy. They think they need to have this elaborate rule set, but you need a rule set that you have an edge,
Hmm.
an intuitive edge, okay, relative to other market participants. You don't want to be an AI algo trader when you are, a small investor. You're going to have your head handed to you probably. But what you can do is you can dollar cost average into an index fund. That is an edge. Not a lot of people do that. And your edge is that the probability of you making way more than inflation is very, very high over time, over 5, 6, 7,
Hmm.
10 years. So that I would start just very simple. And then all the other stuff with Can Slim and 7% stop and all that, that's, for another day. But I would just stay simple and do what you did, Mike. Just start with a small portion of your money and look at it as a learning experience. For me, there's no paper trading. There's no such thing as paper
Yeah.
trading. In today's age, with zero commissions and odd lots and everything that you can trade, forget it. Just start real. Your biology will learn a lot faster when real money is at stake.
Could not agree more. Back testing is one thing, historical back testing, because you can't paper trade or you can't trade in the past. You can't go, oh, I want to go short in October of 87, and call your broker because
Yes.
that's not possible. But you want to learn from history. But in the real battlefield, you have to put money at risk to learn to get that because it's all about emotions, right? The goal, as far as I'm concerned, is to find the strategy that works with your emotions because we're all emotional, and anyone who thinks they're not emotional is fooling themselves, And if you're not emotional, write an algo. I, I spent several years writing a couple of algos and learned more from that probably than anything else I did, and probably changed my trading on a core level of doing that. But most people aren't going to take the time nor have the resources to build a full black box algo. But yes, just being it simple. So that's for the newbies. So let's say you've learned those lessons. Now you're trading with a decent size account. You're been trading a few years. You understand the things. What would you say those folks should focus on to move forward?
With one word, I would say leverage, because really the reason why we have an edge as investors in stocks is because every year we have money's growing. Our M2 money supply grows by about 6%. And that's like your minimum increase per year on average. So what I would study more of is leverage and how to get cheap leverage in prudent ways. One, our daughters have two businesses, and what I've done recently is I've explored business credit cards, 0% business credit cards, and you can get, combination of different cards and different people, easily 100,000 for free for 0%. So I would take all the leverage, the prudent leverage, and I would focus always on the low hanging fruit. Like, for example, what I tell people in our chat groups, I say, go talk to your broker. If you're on margin, make sure you're not paying more than 5%. Schwab will charge you a ridiculous 11% if you have a small account and you don't ask. So go for
Wow.
the free. That's what I refer to as a little bit of a free lunch, getting your margin
Yeah.
from 11% down to 5, and Schwab will
Yeah.
probably give it to you. Of course, there's no rules there. And then also the other thing is negotiate your options commissions down. And then any form of leverage, your mortgage, your expertise, YouTube videos, that's leverage. Coming to an in-person meetup, that's leverage because you have all these people concentrated there that you can exchange. And then for me, as far as like investing and advice like that, is teach somebody else. That was my shortcut. I didn't know it at the time. I just kind of got thrown into this meetup role, but I didn't know it at the time. But that was my shortcut to learning a hell of a lot faster because I got a lot of
Uh-huh.
questions from people. And now with options, it's even more complex when you have to explain to somebody who's never dealt with options. And now they're selling options. That is so
Yeah.
abstract. That doesn't exist in nature. Momentum and growth
Yeah.
stocks, that exists in nature, but selling an option does not exist. So teach a kid, have him dollar cost average.
I think that is great advice. And then and there's something and Bill would say it too, like with teaching, then it forces you to learn because if you care about how you come across, you want to you want to know the answer before somebody asks it. And so it forces you to really understand whatever it is that you're teaching. And so it
Yeah.
does speed up that learning curve because you're like, wow, I better know this because what if someone asks me about what's on page 237? I better know. Okay, so then the final thing is let's say someone's been trading longer than you've been trading. What advice would you give to them on how they can improve, whatever they're doing?
Well, that's a really tough one.
It is a
Do you
tough one,
mean
right?
Do you mean by that somebody who's more competent than me?
No, someone who has
That look-
more experience, someone who's had more experience than you, because
Like if
so
I have to give, if I had, if you advice,
yeah. Well, no,
like
I mean,
that,
well, I mean, we've had the same number of years. I mean, I got in the industry in '93, and you got in the industry about the same. So we're peers as far as experience. But I'm talking about someone who got in the industry maybe in the '70s or '80s. So I put so much weight on experience, because when I talk to people who've been around the block longer than I have, and I wasn't always this way. When I was a punk kid at 28 or something, I was always down to earth, but in my head, I always thought I knew so much more than these people. But I've realized now
I'm with you.
that you don't know until you've been in that fire, because you don't know how you're going to do, you don't know how you're going to mess up, what you're going to do right. And there's this thing with experience. Even the people that are newer now, that you lived through COVID, the COVID bull, bear and bull. Now, what we had with the tariff thing or with Iran, just that short period of time, how much we everyone, you, me, and everyone else who's traded through that, you gain this experience that you wouldn't have had beforehand. And there were different things that happened there. These V-shaped bottoms that weren't happening before. They were different before. Now it's this experience. So knowing that, I'll just tell you what I would tell somebody who's
Yes, I would
traded
love to
longer
hear
than
it.
me. Yeah, would be to go back and study even more history, because that is the equalizer, and that's what I always did early on, was go back in time, because I was always fighting this. Maybe it's near and dear to my heart, because early on, I got so much for being the newbie on the team, and, um around people that had a lot more experience than me. And so my only way of being able to look in the mirror and go, okay, I'm as good as them and I want to be better than them, is to go back in time and study more and just be able to put in the work. Because just because you've been through it, yes, you get this experience that you can't get if you've never been there. But the one thing you can do is use that change date and market surge or whatever platform you like to use, and go back and and study in the front of Bill's book all of these charts, because that's where you get the edge. The Northern Pacific, 'cause someone would say, okay, well, why am I going to learn about something 120 years ago? How's that going to help me? Well, it would have helped you with car, would have helped you with GameStop, it would have helped you with AMC. So that's how I would have responded. So if you don't have an answer, I don't want to put you on the spot, but what would you say to someone who, if you want to answer, who's been doing it longer than you?
So for me, it's all about uncommon thinking because I've seen so many people backtesting this and that, but there's always the uncommon thing that will happen that nobody predicted.
Mm,
Um, who predicted that silver was going to go up 200% last year and gold
no
100%?
one.
Like not even close. Who thought that after COVID, like when the market tanked 30%, that it would be up like 20% higher than pre-COVID within a year? And that's just crazy things like that, to where there's always, the long-term capital management like perspective where they thought they knew it all.
Yeah.
But the black swan happens more often than not. There's and that's just why you can even make money. So especially with options, where you can make really good money, but it comes in fits and spurts.
Yeah.
It's like with car. That's a few days, and that was my most successful trade ever, and it's over. And it's never going to be one of these trades. Is never going to be handed to me like that on a silver platter. Almost for certain. Maybe something similar, but not this lucrative. And so, yeah, that uncommon. So here's the thing that I really recommend is expose yourself to thoughts that are counter to yours. I used to listen to Rush Limbaugh. I used to listen.
Oh, so did I. He was I listened to him in my my 20s, and rest in peace, Rush. I know a lot of people hate Rush, and that's fine. Doesn't, it depends on what spectrum of things you are, conservative or liberal, where you'd think. But you probably listen to him because you were on the other side, I would imagine,
Well,
which is
no, I'm politically pretty moderate, but I also listen to Amy Goodman on
okay.
NPR with her piece and whatever war report or whatever it was called.
Okay, got you. Yeah.
I, listen to Laura Schlesinger, and then I listen to these
Oh, I was a
other more
huge fan of Laura.
names. Yeah,
Dr.
I mean,
Laura, so
we listen
good.
to her in the car all the time. My wife and I, we were just in the car. We had the radio,
Yeah,
and
she's so good. Have you read her books? I've read almost all of her books, and they're
no,
really,
I didn't go
really good.
go do the right thing or happy kid. No,
Yeah, Bad
unhappy kid.
Childhood, Happy Life, or something along those
Yes.
that was I read that even though I had a very good childhood, a lot of people that I care about didn't, and so I wanted to read it from their lens. And there's so much in that. It's nothing about stocks, but in essence, it's basically if you have a terrible childhood or a terrible thing happen to you, don't let that hold on to you for the rest of your life, which is something I trying to deal with myself. And so yeah, I highly recommend her stuff. I haven't listened to her stuff in a long, long, long time, but she was very sound as far as I'm concerned. I'm sorry, I kept on interrupting you, but I'm
You
known
know,
for
but
that.
the point is with bringing up Rush Limbaugh and Amy Goodman and
Yeah.
Dr. Laura is listen to people that are totally like counter your thought process. I get these get rich quick scheme like YouTube video things. Every now and then I click on them and I listen to the whole thing, and I go on their website and just because I wonder how they think, how they attract people. And then I also listen to things like Wyckoff or whatever, things that I don't really like relate to, but I want to know how they think, and just uncommon thoughts. These echo chambers, I think they're unhealthy.
Mm,
So we need to engage in dialogue, be it for honing your investment skills and always finding a reason why what you believe is untrue. Where are the
yep.
holes that it can punch in, or just in general that we have more conversation. And one of my conversation between the different strata of people, poor, rich, whatever, color, not color, I don't care. Just converse. And if somebody wants to learn about investing, we're very welcome for them to come, but they have to do their own part to study that. Yeah,
I
that
love I, I love that response on that, and it made me think of something that I don't want this to get political at all, but what because Bill and I had the same, we're both very conservative, even though I don't might not look like I'm conservative, but I'm very conservative with my politics, and so was he, and I learned so much from that. But he told me, he's like, "Mike, make sure you're watching CNN and MSNBC," which if you're not from this country, those are thought of as very liberal, whereas Fox was very conservative. And I don't watch any political stuff anymore at all. I had to drop politics from my
Amen.
life because it was adding too much stress and too much division. Like so many people hate people because they don't have their and I'm not about hate, I'm about love, and I just
Stay away
stopped
from that.
cold turkey.
I'm with you. I'm so with you.
Yeah. But the point that he said was listen to the other side so you understand the argument. And then, because sometimes you'll be on one side of the spectrum and you hear something from the other side, you're like, yeah, they're right. It's not like one side is right on everything and the other
Yeah.
side is wrong on everything. It's something in between. And I think it's an important thing. And it kind of goes along with what you were saying is like, listen to everybody with an open mind. And
Yes.
you never know what you're gonna pick up, and don't pigeonhole people like, "Oh, this guy is, you know, some hippie or something. I'm not gonna listen to him because he couldn't possibly know what he's talking about." With that said, we're gonna switch gears here before it's midnight over there for you. This is my favorite part of things. We're no longer talking stocks, we're talking music here, Hans. What is your favorite album of all time?
It's Evolution by Scotch. It's Italo disco.
Evolution by Scotch. So Scotch. Okay. Spell Scotch for me.
So it's really all for me. It's all about with the one song called disco band. You probably can find Scotch disco
Okay,
band.
I got it. Oh, so it's Scotch, just spelled normal Scotch. Okay, let me go
It's a
there. I'm just
complete, I'm such a child of the 80s. You're 2 years older than me, but also keep in mind, I grew up in Europe and I didn't get
okay.
all the American influences much, but the Italo disco, so this is my all-time favorite Scotch disco band, and they have a totally crazy video in the hospital. It's just completely stupid. But I used to spend a lot of time on MTV. We didn't have a TV, but I was at other people's homes watching these videos, these music videos. And so my second all-time favorite song is Radio Gaga by Queen.
Oh, Queen, I love Queen. That was actually the first album I ever bought was Queen's The Game. But no, we're gonna go through Scotch because this is interesting because I had Steve Sweats on the other day, and he brought up a band that had never listened to their music, and then so I allowed me to venture in, and I listened to his favorite songs of it the next day. And so we're going to go through this because this is the way that we all get to learn new things. So Scotch in the album is Evolution. So I'm going to go through three of these songs at a time, and you're going to tell me which one out of those three is your favorite, and then we'll wind it down to your absolute favorite. And I'm going to listen to that after the show. So first one is Primitive Man, then Take Me Up, and then Man in the Man.
Take Me
Those
Up.
Take Me Up. Okay, then Born to Kill, Coburn, I think, and Del Rio Mine. I'm just butchering these.
Oh,
Out of those,
Born to Kill.
Born.
Born to
Okay,
Kill.
good because that's the easiest one for me to say. Okay, Loving is Easy slash Evolution, Disco Band, Losing in Time, or Penguin Invasion. Wow, that is different. Penguin
That's a new one. They
Invasion,
didn't used to
huh?
be on there. That's an addition, a disco band.
Oh, disco band. Okay. So you're going to pick my playlist for the rest of the day. Well, at least I'm going to listen to it once. So is it going to be Take Me Up, Born to Kill, or Disco Band? Which was the best song on that?
Disco band.
Disco Band. Okay. Now you know I hate disco. So this is ballsy of you, Hans, to bring a disco thing to me. I mean, seriously, I've got the band t-shirt on and you are bringing in disco to Webby Rambles On. You've got guts. I'm very proud of you.
You could
That's wonderful.
switch to Born to Kill. That's not like as crazy. Speaking of
No.
Grateful Dead,
I'm sticking with disco band, and I'm gonna sell some puts on that and buy some calls. I'm gonna do all sorts. I'm gonna do butterflies and strangles, and I'm gonna do some gamma squeezes on this. Well, this was a blast. I had so much fun. Say hi to your wonderful family. They were just so nice. I really loved how you flew them out here. We are trying to do something maybe next year where we get a group that goes over there. It's still a little bit up in the air, but we would hope to go over to Switzerland. And
yes,
do you want to talk about at least what we're hoping to do, and maybe there'll be some
yeah.
interest and we'll be able to get that done?
So basically, we will move our Can Slim event to Switzerland and probably be a separate event. I mean, not Can Slim Up, Grow Stock of
Yeah.
San Francisco. And we would have two groups. One would travel maybe 5 days early or a week early, and I would do a tour to uncommon places. We wouldn't go, I mean, you could do that on your own, but we wouldn't go to the Matterhorn and Jungfraujoch and all that stuff, and Lucerne. You could do that on your own, but I would take you to some uncommon places, and I would do a group before the meetup, and then we would have the meetup for 2 days. And then afterwards, I would take a second group, maybe some of the same people come, and do another sightseeing excursion. So we would really want to plan it well ahead of time.
Yeah, that would be a blast. I know my better half is definitely in. Every time I tell her about it, I'm like, we might do this, but now I got to figure out how to get that time off of work and everything for the travel. But I would love to be part of that, and if that happens, nothing would make me happier than being over there. I've only been to Europe once, and that was for a workshop in London in either 2012 or 2013. I brought the family over and we rented a a play after the event. We rented a place out in the country because I wanted to be close to Eric Clapton's house and check
Well,
that stuff because I'm a huge Clapton fan. And then we went and found his house. My son named after Eric Clapton. We took a picture in front of it. I've posted it before.
I,
We didn't get arrested for being a stalker or anything like that, but that was fun and just so beautiful. And I learned those roundabouts and driving a left-sided
oh
or
man, that's talent.
the right-sided car with my left hand using the stick shift, and I hadn't driven a
Yep.
stick in like a decade or so before that, and boy, that was a trip. Do
Wow.
you guys what side of the road do you guys drive in
You
where
drive on
you
the right hand side,
okay, is your steering wheel on the right or the left?
on the left.
Okay, so it's normal, so I'd be comfortable there, okay, because that
Yeah,
was weird. I thought I was gonna get in an accident, but after a
yeah, man,
couple
I would
days,
not want to drive in England, man.
it
Forget
was
it.
it was trippy because when I got there and I got the car and I hadn't even thought about the whole driving on the other side of the road thing, and then they only had a stick shift. I'm like, "Are you kidding me?" So now I've gotta drive stick and
With the left
learn the
hand.
my god, that was the first 2 days I was a nervous wreck, but then, it's just like anything else, you get used to it. Well, hey, this was a ton of fun. I really enjoyed it and really looking forward to October. Thank you so much. Any parting words that you would like to
Yeah,
leave?
yeah. One parting word. You talked
Yeah,
about the Grateful Dead, and
sure.
let me show you. I used to. These are some Jerry Garcia ties. These are
Oh, I've
actually
been staring at those. I thought those were Jerry ties back there.
the reason, and I'm not a Grateful Dead fan, but the reason I have them is I used to have an office. I shared an office with the manager, like after they disbanded and stuff, of the Grateful Dead in Mill
Uh-huh.
Valley, 20 Sunnyside Avenue. My wife was running this mail shop thing at the same address, and I was having this little office. He was subleasing to me, and he gave me all these ties. These
Oh
were
my
like
god.
original, like when before they rolled them out, they made one of them or a few of them each, and he had a whole box, and I was able to pick a few.
Wow, those are like prototype Jerry Garcia ties
Yeah,
that you have?
they are.
Oh
They
man,
are.
do not get rid of those, man. Those are you've got to become a deadhead at some point. Come on. You lived in the area and you've got Jerry ties and you're not a deadhead. There's something wrong with you. I knew that there was something wrong with you, Hans. You're into
The 80s
disco.
messed me up.
Well, that's a wonderful thing. Thank you for sharing those. If I ever wear a tie again in my life, I am gonna buy my. I've never bought my. I didn't become a deadhead until March of 2014. Topic for another day. So I missed that whole thing. Now I'm a hardcore deadhead. Obviously, now Jerry's behind Jimmy at this point.
Yeah, yeah.
But yeah, people need to give them a try. I had a closed mind at that point, just like my mind is closed towards disco, but I'm going to be listening to Disco Band in about 5 minutes. So thank you so
Very good.
much. And I will see you in October. Peace out, guys.
Perfect. Thank you. Peace out.